Hello students, hope your preparation is going good, and this is your Mr. GST CA Vishnuvardhan coming up with a quick revision video about input tax credit chapter, the very important chapter for your exams, you know that. So this chapter we are going to quickly revise in no time, which will be definitely helpful for your revision purpose. So let us go into the video. So input tax credit, you know, everybody see, first of all, just to correct your basics. See, when we are making outward supplies, sir, our outward supplies may be covered under forward charge or may be covered under reverse charge. If they are covered under forward charge, what we will do, we will collect tax from the customer and we have to pay it to the government. While paying it to the government, we will use our ITC balance, and if it is not sufficient, we'll go with cash. Sir, no sir, whatever the outward supplies we are making, that is sales, if it is covered under reverse charge, we will raise the invoice, we will supply the goods or services, our customer will directly go and pay the GST to the government. We don't have to do anything. So what is the only duty we have? Eat 5-star, do nothing. So that is the scenario. But sir, here one important thing, yes, one important thing is, because we are making outward RCM supplies, we cannot take ITC on our inward supplies. Hope you remember that. Right. Now coming to the next one, sir, if I am making purchases, if we are making purchases, whether it is covered under forward charge or reverse charge, sir, if it is covered under forward charge, what we will do? We will pay GST to the supplier, supplier will pay to the government, and government will give it to us as ITC. Same way, if the purchases are covered under reverse charge, what we will do? We will directly go and pay GST to the government. Government will give that amount as ITC to us. Simple. So here the only thing which we have to remember is, sir, whether the purchase is covered under forward charge or reverse charge, you can happily take ITC. So please remember that it is your purchase. Your purchases, if you are buying it for business purpose, you can happily take ITC. So whether it is covered under forward charge or reverse charge, the only condition is, you know, sir, when we are buying something, we should use it for making taxable outward supplies, then only we can take ITC. If we are making it, like using it for making exempt outward supplies, we cannot take ITC. But we are using it for taxable supplies, we can take ITC. That we will discuss in section 17, nothing to worry. So this is the overview of GST liability. So what is that we have to understand? See, sir, whenever there is GST payable to government, GST payable to government can come in two circumstances. One is on your sales, the other is on your purchases. If at all GST liability comes on your sales, then, sir, if you are going and paying GST, you can use your ITC balance. If it is not sufficient, use cash balance. Because to pay output tax, you can use input tax. If it is not sufficient, pay cash. Right. Sir, no, sir, I am going to pay GST under reverse charge mechanism on my purchases. Then again, simple. See, if at all you are purchasing something and paying GST under RCM, this is your input tax. So you cannot use input tax to pay this. So you should pay this only in cash. So simple. When you have GST liability in hand, that is directly to pay to the government. If you sell something, you have to pay directly something to the government. So that output tax, you can use input tax or cash. Sir, I am purchasing something covered under reverse charge, so that is your input tax. So to pay input tax, you cannot use input tax, so you should use cash only. So that is what the concept here. With this overview in mind, let us proceed into the chapter. So before proceeding into the chapter, you should remember, or you should understand, sir, whenever we are buying something under GST, that may be goods or that may be services. Goods, if we are buying, if we capitalize that, then it is called capital goods. If we don't capitalize that, then it is normal inputs. Hope you are clear with this. If we buy some goods and we capitalize it, it is called capital goods, and if we buy something and we don't capitalize it, if it is goods, we call it as inputs. But sir, for services, there is no such differentiation. We call it as input service. Whether you capitalize or don't capitalize, all that nonsense. Okay. Goods, capitalize, capital goods. Not capitalized, inputs. Services, straight away input services. Hope you are thorough with that. Right. So with this, let us proceed with first point, section 16. Section 16 has 4 subsections. Earlier, now they have added subsection 5 and 6 also. 5 is not relevant for you. Subsection 6 we will be discussing. Okay, so first going to 16 subsection 1, simple, sir. 16 subsection 1 says every person who wants ITC, he should be registered under GST, sir. Without registration, how will I give you ITC? So you should be first registered, and of course, whatever you are buying, you should be using it for business, or you should have intention to use it for business. That means not only the goods or services, whatever you procured, the goods, whatever lying in the godown are also liable for, are also eligible for ITC. Not only the goods which you have used in manufacture, but also the goods lying in stock, lying in godown are also eligible for ITC. That is what 16 subsection 1 says. Sorry. So that is 16 subsection 1, simple, eligibility for ITC. Let us move on to 16 subsection 2. So coming to 16 subsection 2, what are the conditions for availing ITC? 16 subsection 2 number also you should remember properly. So please make sure you remember 16 subsection 2. What is 16 subsection 2? Conditions for availing ITC. Sir, what are the conditions for availing ITC? Number 1, simple sir. You should be possessing some or the other documentary evidence, sir. Then only I can give you ITC. Without that, sorry, I cannot give you ITC. So please have some documentary evidence. What is that documentary evidence, sir? That can be a tax invoice, that can be a debit note, that can be a revised tax invoice, that can be bill of entry, that can be document issued by input service distributor, or that can be a self invoice also. Sir, please give some documentary evidence so that I can give you ITC. Okay, so please have that. And one more thing is what, sir, if at all coming with this documentary details, if you see any demand that is raised, sir, any demand that is raised on account of fraud or willful misstatement or suppression of facts cannot be availed as ITC. So if this is done on account of fraud or willful misstatement, suppression of facts, all the stuff under section 74, okay, then also you cannot avail ITC on that. That is what another point. Next, no ITC will be given to a registered person in respect of invoices or debit notes which have been furnished by the supplier in GSTR1 or IFF, and the details are reflected in GSTR2B for the recipient. That means simple, what we are trying to tell here, sir, for you, if you want ITC, your supplier should have filed his GSTR1 and it should have been reflected in your GSTR2B. Then only we will give you ITC. Otherwise, you are sorry, go and fight with your supplier. We will not give you ITC because it is not reflected in your 2B. So simple, if it is reflected in your 2B, then only you can take ITC. If it is not reflected in 2B, go and fight with your supplier. Don't come and fight with department. That is what they are saying, right? Next, what is the next condition, sir? The next condition is what? If you are buying some goods or services, if you have actually received the goods or services, then only you can take ITC. Sir, goods are in transit, or I will receive the goods tomorrow, day after tomorrow, like that. If you keep on telling stories, we will not give you ITC. Please understand that. Okay, only if you actually received the goods, then you can take ITC. Sir, on behalf of me, my job worker has received, sir, the goods. Who will be working on behalf of me, sir? Will you give me ITC? No problem, we will give you, don't worry. So goods can be received even by the job worker, even by some third person on the directions given by you. Still you can take ITC. Sir, what if the goods are coming in lots or installments? Sir, 10 lorries the goods are coming, sir. 8 lorries came, sir. 2 lorries are still in transit. Then only after the receipt of last lorry you take ITC. Okay, don't come and disturb in middle. Okay, so that is what the concept. So I repeat, actually goods or services should have been received by the recipient to claim ITC, even if this job worker or any other third person for that matter has received it on the directions of the recipient. Still recipient is eligible for ITC. Another additional point here is, sir, if at all goods are received in lots or installments, only after the receipt of last lot or installment you can take ITC, but all that lots or installments should be covered under single invoice. That means one single invoice, 10 lorries are coming to transport the goods. Then after the receipt or after the delivery of 10th lorry only you can take ITC. No sir, 10 lorries, 10 different invoices. Then how many lorries deliver the goods? That will be the last lot, so that you can take ITC. I repeat, if it is single invoice, 10 lorries, then after the receipt of last lot only you can take ITC. You should be careful in the questions, where in the questions they will say goods, the last lot will be received in the next month or that next month. This month can you take ITC? No sir, this month you cannot take ITC. I am extremely sorry. Clear? So that is what the concept. Okay, next. Sir, whatever is reflected in 2B, will you give me ITC? Yes, I will give you ITC, but it should not be restricted by the government. Okay, so that means government has the power to restrict the ITC, whatever has been reflected in 2B. So you cannot take ITC. Okay, so using section 38, government has used that power, and still they have framed section 38. They have not yet fully utilized that power, where they are saying that if at all you are buying something and it is reflecting in your 2B, and that purchases are from a person who is a new registrant or who has defaulted in paying taxes, whose output tax as per GSTR1 and 3B are mismatching. So in one he is showing more liability, 3B is showing less liability. Okay, and who is availing ITC more than what is there in 2B, and sir, who is defaulting his tax liability under section 49 subsection 2, that is rule 86B, or any other specified class of persons. From these people, if you buy something and if it is reflecting in your GSTR 2B, I am extremely sorry, we will not give you ITC. And please understand, this is still in a section phase. So for this, rules has to be prescribed, and as of now there are no such rules which are talking about this, except of course here this point and this point, actually not this one. Okay, certain points have come into effect, certain points not come into effect, leave it. Okay, if these are the cases, the government in this case can deny you ITC. Okay, that means what? Whenever you are buying something, you should do background verification of the person from whom you are supplying. That means you should take the GST number of the supplier, go to the commissioner, sit in front of the commissioner and say, sir, tell me the horoscope of this fellow, whether this fellow is paying taxes correctly or not, whether this fellow is taking ITC properly or not, tell me I should buy something from him. That means do some background verification, just like when you are getting married, you will do no background verification. The same way, do background verification of the supplier, do background verification of the supplier before buying the goods or services from him. Otherwise, your ITC will be at risk. That is what this point all about. Okay, fine, sir, no problem. That means what? Government can deny ITC for you even though it is reflected in 2B. Simple. Next, sir, the supplier should have discharged his tax liability. That means supplier should have paid taxes. Then only recipient will get ITC. Okay, here with respect to this, we have section 41 read along with rule 37A. If you see what the law is saying. See, GSTR1 supplier is filing, recipient will get in his 2B, recipient will take ITC. But who will give money to the government? Supplier should give money to the government. How he will give? By filing GSTR 3B. That fellow supplier from whom you have purchased, he filed GSTR 1 properly, but 3B he did not file. That means he did not pay tax only to the government. But you enjoyed ITC, recipient. So what the law is saying here, the recipient, if you have taken ITC because it reflected in 2B, why it reflected in 2B? Because your supplier filed 1. But whether your supplier has filed GSTR 3B, that you please check. If that fellow has not filed his GSTR 3B, by 30th September of the succeeding financial year, whatever ITC I gave to you, please give it back to me, because I did not get money from your supplier. Like that government is asking. So before 30th September, your supplier should have filed this GSTR 3B, okay, and paid taxes to the government, which you got as ITC already. If he has not done that, by 30th November of the succeeding financial year, that means in another 2 months time, you should reverse the ITC without any interest. Without any interest. 1 second. Here I have given one example. See. But sir, if you don't pay that, within 30th November, then what should be done? You should reverse the ITC along with interest under section 50. That is the twist. Okay. Okay, sir, I will reverse the ITC along with interest or without interest, as the case may be. What if after 2-3 years my supplier becomes a good boy and file his GSTR 3B and pay tax to you? Can I re-avail ITC? Yes, you can re-avail ITC. Sir, is there any section 64, 16 subsection 4 time limit would have been over? No, sir, by that time. 16 subsection 4 is not applicable in this case. Yeah. See, understand, 16 subsection 4 is applicable only for availing ITC. Here, this is re-availing ITC. So 16 subsection 4 is like, see, only when you are getting married for the first time, they will see age. For second time marriage and all, they will not see any age. That means 16 subsection 4 time limit is applicable only when you are availing ITC. Here you have availed ITC, reversed ITC, and again now re-availing ITC. So in such cases, 16 subsection 4 time limit is not applicable. Hope it is clear for you, right? So here what we are trying to tell, sir, in short, what is that you are trying to tell, sir? See, supplier has filed his GSTR 1, because of that you got it in your GSTR 2B, but supplier did not file 3B. That means government did not get money, but recipient got ITC. So government is under loss here. So what government is saying, by 30th September, if you are 30th September of the succeeding financial year, if your supplier has not filed his GSTR 3B, then you should reverse the ITC by 30th November without any interest. I'm giving you 2 months time without interest. By 30th November also, if you have not paid that, then reverse the ITC along with interest. Tomorrow, if at any point of time that buffalo files GSTR 3B, who? Your supplier, then you re-avail ITC. Only re-avail ITC, interest you cannot re-avail. Okay, please understand that. And here for re-availing ITC, 16 subsection 4 time limit. 16 subsection 4 time limit is not applicable. Okay, so that is what the point. Okay, wonderful, super. Okay, if you want to just go with this example, see here, just go with this example. 1 second. Yes, you can take a screenshot of this if you want. Hope it is clear. You can pause the video also and you can just go through the example once. I've just given it along with the dates and numbers for your clarity. Okay, hope it is clear for you. Section 41 read with rule 37A. Okay, let us move on to the next one. The next one is the first proviso under section 16 subsection 2. So the first proviso we have already discussed. When the goods are coming in lots or installments, we can take ITC only after the receipt of last lorry or last installment, whatever it is, but they should be covered under single invoice, that we have already discussed, right? Let us move on to the important proviso, second proviso, read along with rule 37. What is this rule 37, second proviso? Do you remember, my dear friends, that 180 days time limit concept? So if the supplier makes any supply to the recipient has to make payment to the supplier, both value and GST, within 180 days from your birthday or my birthday, from invoice birthday, that is from the date of invoice. Yes, he has to make the payment, not only value but also GST. If he is not doing that, he should reverse the ITC along with interest under section 50. One interesting thing here is, if you have made part payment, proportionate amount will be considered. For that I will show you one example also. And tomorrow in future, if you make payment later on, maybe after 180 days you have reversed the ITC, after 200 days, 230 days, 360 days, 440 days, whatever it is, you have made payment to the supplier, can you re-avail the ITC now? Yes, you can re-avail the ITC. You know, re-availing ITC, there is no time limit only, correct? So only for availing ITC there is time limit. 16 subsection 4 is not applicable when we are re-availing the ITC. So happily you can re-avail ITC, but interest will not come. Am I clear? So I repeat, within 180 days from the date of invoice, recipient should make payment to the supplier, both value and GST. Otherwise he has to reverse the ITC along with the interest. Later on in future, if he is making any payment, he can just re-avail the ITC. 16 subsection 4 time limit is not applicable, and he can re-avail the ITC. Interest part he cannot take anything benefit. Okay, if at all he has made any part payment, the proportionate amount he has to reverse. Now this 180 days reversal concept is not applicable for these three cases. Number 1, supplies covered under reverse charge mechanism. Number 2, deemed supplies without consideration, that is schedule 1 transactions. And whatever the additions we have made to the value of supply, if you remember section 15 subsection 2 inclusions, obligation of the supplier discharged by the recipient, so that is added to the value of supply because it is already discharged by the recipient. Okay, so again recipient will not pay that amount to supplier. If you remember that Pushparaj example, 10 lakhs furniture, you are paying me 6 lakhs and directly 4 lakhs to Pushpa, so that case only. Okay, so that is what the point. Okay, for that 180 days time limit is not applicable. So here if you see, sir, 1 lakh plus 18,000 is the GST. So 1 lakh 18,000 you should have paid. What if you have paid only part amount 60,000? Part amount 60,000. Okay, with ignoring interest, if you calculate what is the ITC here, sir, to be reversed, you should pay 1 lakh 18,000, but you have paid 60,000. What is the balance? 58,000. But this 1 lakh 18,000, when it is including GST, this 60,000 is also including GST. You cannot take it like excluding GST. Balance amount 58,000 is including GST, which you have to pay. So 58,000 into 18 divided by 118 will give you the reversal amount. 8847 you have to reverse. Okay, so that is the concept. So here if you see, I've given this example, you can just 1 second pause the video. iPad itself is not sufficient for the examples. Okay, so I think it is little bit okay for you. You can just manage it if you take the screenshot. So go with that. This much zooming and all we cannot do, that is a problem. Okay, 1 second guys. Yes, this one you can manage. So please pause the video and go through the example, or just take the screenshot of it and then revise. Otherwise, you know, material is available in our Telegram channel. You can just go with the soft copy, no issues at all. So that's all with respect to that particular point, and with this we are done with section 16 subsection 2. Yes, we are done with section 16 subsection 2 with respect to that. And of course there is a small clarification here with respect to molds and dies which are used. Okay, see here nothing but a small clarification. Let me close this. So here what is happening now, Normally when there is original equipment manufacturer, sir, original equipment manufacturer, what he will do, sir, he will manufacture the equipments and give to component manufacturer. For example, laptop is there, laptop battery, the laptop company will not manufacture, they will give it to original equipment manufacturer, another fellow who will manufacture them, and he will give it to the component manufacturer. Now what happens, please understand, sir, for this we are one second. Yes, see here one small confusion, that's all. See, this original equipment manufacturer is, let us assume, the laptop company. Laptop company will not manufacture their batteries, own batteries, so they will outsource it. So that fellow is called component manufacturer. Okay, so to manufacture that component, what this original equipment manufacturer will do, he will purchase some molds and dies and he will avail ITC. Those molds and dies he will give to component manufacturer for manufacturing the components. Whether this ITC to be reversed by original equipment manufacturer is the point. First of all, understand here that he is buying these things for business purpose and issuing it for business purpose, issuing them for business purpose. Okay, so there is no need to reverse the ITC, and of course component manufacturer also doesn't have any obligation to use his own molds and dies. So original equipment manufacturer giving the molds and dies to the component manufacturer is very much in the course of business. Very simple. I am original equipment manufacturer and I am giving, you are the component manufacturer, I am asking you to manufacture my laptop batteries. I am buying the molds and dies for that and I am giving it to you. Can I avail ITC? Yes, I can happily avail ITC because I am giving that to you in the course of furtherance of business only, for getting my products manufactured only. Now the important point here is, you don't have any obligation to buy molds and dies. I will be providing, then happily I can avail ITC of that. Okay, so now whatever the molds and dies I am giving it to you, is it added in the value of supply which you are providing to me? No, this is not obligation of the supplier discharged by the recipient. Please don't misunderstand. I'll just put it like this. Wait, laptop manufacturer, battery manufacturer. Okay, sir, this fellow will manufacture batteries and give to laptop fellow. Now the problem is, molds and dies this fellow is buying and giving to him. Buying and giving to him. This molds and dies, will it be added to the value of supply? The answer is no, because these molds and dies are not the obligation of the component manufacturer. So laptop manufacturer is buying them and giving it to him. It is his obligation only. It is not supplier's obligation discharged by recipient. That case is not there here. So what original equipment manufacturer will do, he will take ITC of this. Okay, and this value will not be added in the value of supply of this fellow selling battery. On that battery the value will be there, no, for that value molds and dies value will not be added. This is not obligate. This, if you understand, battery manufacturer is the supplier, original equipment manufacturer is the recipient. Okay, that is the case. Fine, hope it is clear for you. Just go through that. And next, okay, so with this we are done with section 16 subsection 2 as well. Yes, sorry, here one more point, small point we have missed out is, yes sir, whatever you said is fine. If the component manufacturer doesn't have an obligation to use his own molds and dies, you are buying and giving, then no problem. What if he has an obligation and you are buying and giving to him? Then yes, we will add it to the value of supply. And original equipment manufacturer can avail ITC? No, he cannot avail ITC. So simple. Supplier has an obligation, recipient is buying it and giving. Can recipient when he purchase take ITC? No. Okay, sir, supplier doesn't have any obligation, recipient only should give them. So recipient buying and giving, so recipient can take ITC, and it will not be added between the value of supply provided by supplier to the recipient. Okay, so that is what the concept here. Yes, so I repeat, original equipment manufacturer is the recipient, component manufacturer is the supplier. Okay, original equipment manufacturer is buying and giving the molds and dies. We should see whose obligation it is. If it is the obligation of the recipient, original equipment manufacturer himself, then in such case what will happen? He will take ITC, and component manufacturer giving supply to original equipment manufacturer, in that it will not be added, the value of molds and dies will not be added. Okay, that is the case. No sir, it is the responsibility of component manufacturer to buy these molds and dies. Then original equipment manufacturer buying the molds and dies cannot take ITC, and the value of molds and dies will be added in the value of supply between component manufacturer and original equipment manufacturer. That is what the case, right? So just now take a screenshot of this or pause the video and go through this, see carefully. This is first scenario and this is the next scenario. So the next one is 16 subsection 3, simple one sir. If you are purchasing capital goods, on that you have paid GST, that GST component take as ITC, that is one option for you, or add the GST component paid on capital goods to the cost of capital goods and claim depreciation fully, that is second option for you, but don't do both. So simple sir, you have purchased 100 lakh worth capital goods and you have paid GST 12 lakhs. Sir, this 100 lakhs, of course, you capitalize and you claim depreciation on this, no doubt about that. But sir, on this 12 lakhs, you either take ITC or you claim depreciation, but not both. Both not possible. Clear? So that is 16 subsection 3, simple one. So the next one, very important section, 16 subsection 4. You should remember the subsection number as well. You know that, sir, what is time limit for availing ITC? The time limit for availing ITC is 30th November of the succeeding financial year or actual date of filing annual return of the relevant financial year, whichever is earlier with respect to any invoice. So what we should see first, we should take an invoice. We should see for which financial year this invoice belongs to, and from that financial year, next financial year, 30th November or actual date of filing the annual return of that financial year to which this invoice belongs, whichever is earlier, that will be the deadline to take ITC. So here if you see invoice number 183, sir, belonging to 23-24 financial year, 23-24 financial year, received by MSD, on which GST paid is 10,000. Now, sir, this invoice belongs to 23-24 financial year. What is the deadline to take ITC on this 10,000? We should see, sir, 30th November of succeeding financial year, that is 24-25 financial year. That means 30th November 2024, or this invoice belongs to 23-24 financial year. That financial year, when you are actually filing the annual return, whichever is earlier, that will be the deadline. Okay, so that will be the deadline. Hope it is clear for you. One interesting point here, what we have to consider is, sir, if at all we have given debit note for any invoice and that debit note is falling in different financial year, invoice is falling in different financial year, as I have given here example, sir, invoice belongs to Jan 2024, sir, and on that 4,15,000 GST has been paid, sir. Debit note has been given on April 2024, which is coming in 24-25 financial year. That means invoice is coming in 23-24 financial year, debit note is coming in 24-25 financial year. For invoice, yes, 16 subsection 4 time limit will be okay, 30th November of 2024 or actual date of filing annual return of 23-24 financial year. But for debit note, what is the relevant financial year we should consider? Should we consider the invoice financial year or debit note financial year? That is the concept. Sir, for invoice, relevant financial year will be the year in which invoice is raised. Same way, for debit note, the relevant financial year will be the financial year in which debit note was raised. Okay, don't link this to invoice financial year, please. That is what the concept. So I repeat, the relevant financial year for invoice will be the financial year in which invoice is raised. The relevant financial year for debit note is the financial year in which debit note was raised. So that you have to consider and calculate the time limit under section 16 subsection 4. With this we are done with 16 subsection 4. Now let us move on to this new subsection 16 subsection 6, actually a very interesting provision, and I am going to simplify it in such a way you will definitely love this explanation from me, right? 16 subsection 6. What is 16 subsection 6? Time limit for taking ITC in case of revocation of cancellation of registration. Please understand, sir, what is this all about now? When your registration gets cancelled and you are asking for revocation, sir, there is a period of cancellation. From the period of cancellation till the revocation, what is the time gap is there? For this time gap, you are not able to file the returns. And because you are not able to file the returns during that period, whatever the ITC is there, that ITC you will not be able to avail. And now when you have taken the revocation, now if you see, if you look back and you want to take ITC for those periods which over during that like cancellation and revocation period, if you want to take ITC, 16 subsection 4 time limit is over. In that case, how to handle? Now see, first of all, simple, what is this provision talking all about now? The date of cancellation, at the time of cancellation of that registration, for me during this period, I repeat, the period is between cancellation to revocation. For this period, whatever the returns you did not file, so for that period you have not taken ITC also, because you could not file your 3B. Now for that period, see, what we have to understand is, at the time of cancellation, whether 16 subsection 4 time limit was still available? Yes sir. Then in such case, please understand, avail ITC as per 16 subsection 4. Sorry, one second. So at the time of cancellation of registration, sir, whether 16 subsection 4 time limit is available? Yes sir. Now at the time of revocation, still if 16 subsection 4 time limit is available, that is 30th November of the succeeding financial year or actual date of filing annual return of the relevant financial year, whichever is earlier. So if that is available, accordingly you proceed. But sir, I'll give you example also for this, so please wait. But sir, at the time of revocation, at the time of cancellation, 16 subsection 4 time limit was available, but at the time of revocation, 16 subsection 4 time limit was not applicable, sir, not available, sir, 16 subsection 4. Then what should I do? Don't worry, for you 16 subsection 6 is coming to help. So 16 subsection 6 says you can take ITC for that period, the cancellation to revocation period, any returns, the time limit for availing ITC 16 subsection 4 time limit is over. Further, still if you can you can take ITC by filing those returns, the 3B, all that, by 30 days from the date of revocation order. 30 days, within 30 days from the date of revocation of cancellation, you can avail ITC. See, for example, I'll tell you, there is a company, Vivar Private Limited. They are not filing their returns continuously for 6 months. Because of that, the registration is cancelled. If you see, from 1st Feb 2024 to 31st July 2024, 6 months continuously they did not file the return. So they got the notice, all that stuff, and registration finally cancelled on 10th September 2024. Okay, 10th September 2024. With effect, from retrospective effect, 1st Feb 2024 itself, they have cancelled the registration. Now here what we have to see is, sir, what is the period of cancellation of registration? Sir, order of cancellation is given on 20th December, but it is cancelled from 1st Feb. So from 1st Feb, I am not able to file the returns. Now, sir, when I go for the revocation I got somewhere in 20th December. Sir, please understand, when I get the revocation on 20th December 2024, if you see, for me, I was not able to file returns from 1st Feb, correct? Because registration is cancelled from 1st Feb. So, if you see, Feb and March 2024, the ITC belonging to those months, the time limit to avail ITC under section 16 subsection 4 was available. For me, ITC under 16 subsection 4 time limit is available at the time of cancelling my registration. So that 10th September they are cancelling the registration. During that time, I still had the chance to take ITC under 16 subsection 4. But at the time of revocation, if you see 20th December, by that time, for me, the time limit to avail ITC under 16 subsection 4 was not available. So simple, when the department was cancelled my registration, for me 16 subsection 4 time limit was applicable for Feb and March. I could have taken that if you have not cancelled my registration. But now you cancelled my registration, and at the time of revocation, if I see, after revocation time limit is over 16 subsection 4. So for Feb and March month, what should I do? You can take ITC by filing Feb and March month returns within 30 days from the date of revocation. The revocation is granted on 20th December. So from that 30 days, so 19th January 2025. So before that, by filing that return of Feb and March month, I can take ITC of Feb and March month 2024, even though 16 subsection 4 time limit is expired, I can go with 16 subsection 6. Okay, that is the point. Suppose, sir, coming to April 2024 to December 2024 returns also I have not filed. For that also I have not taken ITC still. At the time of cancellation of my registration, that 16 subsection 4 time limit is over. After revocation also still 16 subsection 4 time limit is available for me. That is, this is coming in 24-25 financial year, no, 30th November 2025, and actual date of filing annual return of 24-25. Till that I have the time limit, no. So April to March, December 2024 returns I can happily file accordingly, and I can take ITC. I need not see 16 subsection 6 itself. I will see 16 subsection 6 simple words when at the time of cancellation 16 subsection 4 time limit is applicable, but at the time of revocation it is not applicable. In that case I will go to 16 subsection 6. What 16 subsection 6 says? 16 subsection 6 says take ITC by filing the returns, pending returns within 30 days from the date of revocation of cancellation. So this is the notes for that. Hope it is crystal clear for you. This is the new section and very important section for you for your May 2025 exams. So please be careful. Now let us move on to next 17 subsection 5 blocked credits. You know, very important section. You should remember it very well. So 17 subsection 5 blocked credits. Sir, what is this blocked credit all about? Even though you are purchasing something for business purpose, you cannot avail ITC. Yes, even though you are buying it for business, you should always understand, yes, we are buying it for business purpose only, but still we cannot take ITC because it is given in 17 subsection 5. So what are the things which are given in 17 subsection 5? Let us quickly go with them. So first of all, motor vehicles. Sir, motor vehicles with less than or equal to 13 seating capacity, if you are buying even for business purpose, you cannot take ITC. Sir, if I am buying something with greater than 13 seating capacity for my business purpose, yes, you can take ITC. That means company buying a car cannot take ITC. Company buying a bus can take ITC. Company buying a lorry, tippers, dumpers, all that, yes, they can take ITC because they are not the vehicles for transporting the persons. Okay, so goods vehicles are obviously eligible for ITC, they are not covered here. So I repeat, motor vehicles with less than or equal to 13 seating capacity, if you are buying, you cannot take ITC even though it is for business purpose. If it is greater than 13, yes, you can take ITC. If it is a goods vehicle, yes, you can take ITC. And there are certain exceptions here, sir. Even though it is less than or equal to 13 seating capacity, you can take ITC when? Sir, you can take ITC if at all you are using it for transportation of goods. That is not an exception, but that is understood by the law. Next, if you are buying them for transportation of passengers, that means you have travels and you are buying the car, yes, you can take ITC. No, sir, for further supply of such vehicles or conveyances, that means I am dealer in Royal Enfield bike and I am buying Royal Enfield bike, I can take ITC. But a company buying Royal Enfield bike for the use of director cannot take ITC. Next, for imparting training in driving skills. So suppose if you are having a driving school and you are buying the scooties or you are buying the cars for etc for driving schools, then you can take ITC. That is another point. Now here, so what we have understood is, if you are buying the motor vehicle, you cannot take ITC, correct? Sir, what do you mean by motor vehicle? Motor vehicle is defined in Motor Vehicle Act 1988. 1988, and accordingly, sir, motor vehicle means what? Which is mechanically propelled vehicle adapted for the use upon the roads, whether the power of propulsion is transmitted thereto from an external or internal source, and includes chassis to which a body has been attached. All this is not that greatly relevant for us. For us, the main point is what are not motor vehicles. But sir, motor vehicle definition does not include vehicles which are running on fixed rails. That means if you are buying them, you can take ITC. Sir, vehicles which are specially adapted for use inside any factory or within the closed premises, or any vehicles which are with less than 4 wheels and fitted with an engine less than or equal to 25 cc capacity. Okay, so if it is less than 4 wheels and engine less than or equal to 25 cc, if that is the case, it is not a motor vehicle. For example, we are getting some battery cycles, no, so such type of things, these are not motor vehicles. These are not motor vehicles, and you can happily enjoy ITC if you buy them. So that is very interesting thing. So please understand that motor vehicles, if you buy less than or equal to 13 seating capacity, you cannot take ITC. But these three things are not motor vehicles. So even though you buy them for business purpose, even though if it is less than or equal to 13 seating capacity, yes, you can happily avail ITC. You can happily avail ITC. That is the interesting part here. Hope it is clear for you. Okay. No, sir, I am buying less than or equal to 13 seating capacity, but for these purposes, for transporting the goods, passengers, further supply of such conveyances, and imparting training and driving skills, then you can take ITC. In other cases, you cannot take ITC if it is less than or equal to 13 seating capacity. Hope it is clear for you. Next, So the same logic is equally applicable. The same provisions, whatever we have discussed just now, are equally applicable even for the vessels and aircrafts. Vessels and aircrafts. So vessels and aircrafts also, if you are buying for business purpose, you cannot take ITC. But if at all you are buying them for transportation of goods, passengers, or further supply of such vessels or aircrafts, that means you are a dealer in aircraft or vessel, or for imparting training in flying or navigating skills, then you can happily take ITC. Otherwise, you cannot take ITC. Hope I am clear with this. So this is second one. Now coming to the next one, sir, we have understood here you are buying some conveyances. That means it can be vessels, aircrafts, or even vehicles. We call them together conveyances. Common word is conveyances. Some conveyances are eligible for ITC, and majority cases it is not eligible for ITC. If it is eligible for ITC, suppose SpiceJet Airlines has purchased an aircraft and they are eligible for ITC. They are taking general insurance on that aircraft or servicing on that aircraft, repairs and maintenance on that aircraft, they can take ITC. But let us assume Vivar the private limited is buying an aircraft, a chartered flight for its CEO, and please understand whether we can take ITC on that. Vivar private limited is buying an aircraft, chartered flight for its company, and whether it is eligible for ITC, no, it is not eligible for ITC. The ITC is blocked on that chartered flight. If the company is taking general insurance or servicing, repairs, all the stuff, it cannot take ITC. Suppose I am buying a car for my business purpose, can I take ITC? No. For my car I am taking insurance, I cannot take ITC. For my car I am taking servicing, I cannot take ITC. Repairs and maintenance, I cannot take ITC. So now there are certain exceptions here. That is, if you are a manufacturer of that ineligible motor vehicles, suppose Honda company is there. Honda company is taking general insurance or servicing, repairs and maintenance on the stock Honda cars, they can take ITC. Or sir, if at all I have an insurance company taking general insurance on these vehicles, repairs or servicing on those vehicles, yes, I can take ITC. Yes, so that is what the point. So what are the exceptions here? For manufacturers and general insurance companies, they can take ITC on these three things. Okay, but others, if they are taking them on ineligible conveyances, they cannot take ITC. So simple, ineligible conveyances, you take general insurance, repairs and service, you cannot take ITC. But if it is an eligible conveyance, you can take ITC, or you are a manufacturer, you can take ITC, or if you are a general insurance company, you can take ITC of this particular services. Hope it is clear for you. Now, another interesting thing is, sir, if you are leasing, renting, or hiring motor vehicles, vessels, or aircrafts on which ITC is not allowed, that means ineligible conveyances as per our discussion. Those ineligible conveyances, if you are giving on lease or renting them or hiring them, then opposite fellow cannot take ITC of it. Opposite fellow cannot take ITC of it. But there are two exceptions. What are the two exceptions? He is taking them on rent for providing similar category of outward supply. He is taking them on rent for providing similar category of outward supply, or he is taking them on rent to provide to his employees as a part of statutory obligation. In those cases, he can take ITC. I repeat, I am leasing the ineligible for me ineligible conveyance, my car. I purchased it and I cannot take ITC. That is ineligible conveyance for me. I am renting that out to somebody. That fellow also cannot take ITC on that. The rent plus GST I will charge. He cannot take ITC except in two cases. He is taking that on rent to give it on rent. That means to provide similar category of outward supply. Or he is taking it on rent because he is an employer to provide to his employees as a part of statutory obligation. Then he can take ITC. Except those cases, he cannot take ITC. Am I clear? So that is what the concept. Next, understand this leasing is only for that conveyances, not leasing of any other items. So if you lease out any other items, you are leasing your laptop, leasing out your any other plant and machinery, all that. In such cases, ITC is there. It is not blocked. Please be careful. So there are some set of examples here. You can just pause the video and go through them. Yes, hope it is clear for you. Now let us move on to the next one. The next one is, sir, food and beverages, outdoor catering, beauty treatment, health services, cosmetic plastic surgery services, life insurance and health insurance services. If you are buying these things you cannot take ITC, but there are two exceptions. Again, similar category of outward supply, and if it is taken by employer to provide to his employees as a part of statutory obligations. So I am buying food and beverages for my office purpose, for my employees, etc., etc. I cannot take ITC, but I am buying that to give to employees as a statutory obligation. Remember, company policy is different, statutory obligation is different. Your company policy is something you voluntarily created. Statutory obligation, law has mandated that on you. So both are different. Please understand that. So it is not as a part of your company's policy, but it is as a part of statutory obligation. So I repeat, I am buying outdoor catering services because of there is a party happening in the office, some new year party, etc., etc. I cannot take ITC of that. But I am buying outdoor catering services to provide outdoor catering service, or I am buying food and beverages to provide food and beverages, or I am providing outdoor catering because it is a statutory obligation. So these things are generally you cannot take ITC except if it is for providing to your employees as a part of statutory obligation, or you are buying them to provide the similar category of outward supply. Okay, so that is what the concept. Here I have given examples, you can just go through that. Same way, sir, membership of a club, health and a fitness center, you cannot take ITC except if it is taken by employer to provide to his employees as a part of statutory obligation. Next, leave travel benefits provided by employer to employee cannot be taken as ITC by the employer, again except if it is a part of statutory obligation. Examples are there here, you can just pause the video and just go through the examples. So going with the next one, works contract services, if at all, works contract is nothing but both material and labor. So there are two things, works contract services, pure labor contract services. So works contract services, we get from the contractor both material as well as labor, and pure labor contract, you get only labor services. So here what we are trying to do, please understand this works contract services and the next one, construction on own account. One second. Yes, both 2 points. I'm just covering here both the points, just in same area. Yes, right. Now, see, let us assume KGF factories wants to construct their factory building and they're appointing a contractor called Mr. Rocky. Now, what he is doing, Rocky is providing works contract services for KGF factories. Even though it is business purpose, KGF factories cannot take ITC. This is the point. Or imagine KGF factories are buying bricks on their own, cement on their own, iron and steel on their own, labor services on their own, everything, and doing construction on their own account, and they want to take ITC. Can they take ITC? No, sir, I'm sorry. Works contract services also you cannot take ITC. If you are buying the goods and services separately on your own account and you are trying to claim ITC, then also I will not give you ITC. That is what the concept. Hope it is clear for you. Now, sir, there are of course exceptions. I repeat, whether you are taking works contract service or buying everything on your own and getting the construction done, then also ITC is not available. Hope it is clear. But the exceptions are if you are taking this to provide similar category of outward supply. That means Rocky Bhai is outsourcing the part of the work to Mr. Garuda, another works contractor or another contractor, providing services to Garuda. Garuda can avail ITC. Or Garuda buying bricks, iron and steel, cement, all this stuff to provide works contract services, or construction services. Then Garuda can take ITC. Are you able to understand? So you are buying these things to provide similar category of outward supply, then you can take ITC. Or you are buying these things, that is the works contract or construction on your own account for plant and machinery, or it's even foundation, for its foundation, still you can take ITC. But understand here the important thing is that plant and machinery means any apparatus or equipment or machinery fixed to earth by foundation or structural support, and that are used for making outward supply of goods or services or both, and includes such foundation and structural supports. But here the point is not inclusion, sir, the important point is exclusion, because plant and machinery you can take ITC. What are excluded from plant and machinery, on that you cannot take ITC. Are you able to understand? So what are excluded from plant and machinery definition? Sir, land and building and other civil structures, telecom towers, pipelines laid outside the factory premises, these are excluded from the definition of plant and machinery. That means you cannot avail ITC on these things. Any other thing, any machinery, equipment, etc., which is installed or used in the factory for making outward supply. For that construction, if you are taking works contract services or buying some goods and services, you can happily take ITC. Not only for plant and machinery, but also its foundation. If you are buying something, then you can take ITC, no doubt about that. And the last exception is if you are buying this, sorry, if at all you are buying these things and that expenditure is not capitalized, then also you can take ITC. Sir, what do you mean by expenditure is not capitalized? Sir, the meaning is it is actually a revenue expenditure. Then you cannot take, sorry, then you can take ITC. But if it is a capital expenditure, don't treat it like revenue expenditure to avail ITC. Okay. So if it is actually a revenue expenditure, there might be some rainy season, the water leakage, etc., every year it is happening. There are some cracks to the walls because of heavy temperatures and heavy rainfalls or uncertain climatic conditions. Yearly we are doing some patchwork to the office buildings or factory buildings. That is nothing but generally a revenue expenditure to us, that you can take ITC. If it is a capital expenditure, don't take ITC. That is what the concept. So works contract services and construction on own account, both the cases, sir, you cannot take ITC. But if it is for providing similar category of output supply, or if it is related to plant and machinery, or if it is revenue expenditure, you can take ITC. Plant and machinery excludes land and building, civil structures, next telecom towers, and any pipelines laid outside the factory. Then these are excluded from the definition of plant and machinery, so you can happily not take ITC. That is what the point. Fine. So suppose if the pipelines are laid inside the factory, then it is plant and machinery, you can take ITC on that. So that is what the concept. Hope it is clear for you. Here there are examples. Just go with them. Pause the video and just go through the examples. We have already discussed the concept in detail. Next, this one. Pause the video and go through the examples. If you are confident about the topic, no need. Now coming to the next one, sir, if at all you are purchasing something from composition dealer, you cannot take ITC. When you are buying something from composition dealer, he has not at all charged any tax from you. How can you take ITC of that? So you cannot take ITC. Sir, I am a non-resident taxable person, sir. For you, all the purchases are blocked. So under 17 subsection 5, for you, no ITC at all, except the goods imported by you. So local purchases, no ITC. Any services you have imported, no ITC. Only goods imported, you can enjoy ITC. That is what the benefit for non-resident taxable person. Next, sir, I am buying some goods and services for spending them under CSR initiative, sir. Using them for CSR initiative, sir. Sorry, use them for CSR initiative, and because you are doing the social service, ITC also you just ignore, no, forgo that ITC also, so that also not available. So you are purchasing something to fulfill CSR obligations, no ITC for you, right? And not only that, sir, I am buying some goods or services for personal consumption. For example, to attend an AGM, I am purchasing a suit or a blazer, or I got an appointment to meet Ambani ji, I am purchasing a watch, which are nothing but for your personal consumption, you cannot take ITC. So simple, goods or services procured for personal consumption, you cannot take ITC. Not only that, sir, any goods lost, stolen, destroyed, or written off or disposed by way of gifts or free samples, you are giving certain things as gifts to people, or you are writing off certain things, or some goods are destroyed in the factory because of fire accident, etc., those things you cannot take ITC. That is what the concept, right? So here there is one more small point regarding, sir, if at all you are paying taxes because of section 74, 129, 130, that is because of tax evasion or detention of your goods or conveyances, in such cases that amount you cannot take as ITC. So that is what blocked credit all about. Okay, here there is a small clarification. So the clarification is with respect to the time expired goods we are returning to the manufacturer, sir. In that case, what should I do? See, for example, I am a pharma manufacturer. I am sending some medicines or drugs to you. After the expiry of time, sir, after the expiry of the date, sir, you are returning those goods to me because they are unsold. So time expired goods. In that cases, when you are returning to them, if at all it is possible to raise a credit note, I will raise a credit note on you. That means the manufacturer of the medicines will raise a credit note to the distributor. Simple. Wait. Sorry. I am a manufacturer and you are my distributor. I have sent medicines to you, they have expired, time expired. Now you are returning to me. So when you are returning, what I will do? Sir, first I gave a tax invoice to you. Now what I will do? I will raise a credit note and reduce the liability. Simple. But for raising the credit note itself, the time limit is over. Then what should be done? Then you raise a tax invoice on me. You raise a tax invoice on me. Okay, you raise a tax invoice on me and charge GST from me and give it to the government. So simple. So this option is available for equally applicable this clarification to all the goods which are returned to the manufacturer because of time expiry. So what manufacturer can do, because the goods what he has sold has been returned by the customers, he will raise a credit note to the customer. If time is over, what the option is available to him? Sir, customers should raise, that is the distributor should raise invoice on the manufacturer, fresh invoice on the manufacturer, and the manufacturer should pay GST to the distributor. Distributor will go and pay it to the government. That is what the concept. Okay, so with this we are done with section 17 subsection 5, blocked credits. And one more thing with respect to here, sir, samples and free gifts. Sir, whatever I'm buying for samples and free gifts, you know, ITC not available. Sir, buy one get one free, sir. Buy one get one free. See, I'm selling one 5-star and giving one 5-star free. On my purchases, should I reverse any ITC? Not required, because it is just like 10 rupees 5-star, I am selling for 5 rupees. There is output tax. So ITC shall be available. No need to reverse or nothing. The discounts given, sir, buy more, save more. We have seen discounts tax treatment already in value of supply chapter, and you are eligible to avail ITC, sir. Just because you are giving discount, it doesn't mean that you are not eligible for ITC. It doesn't mean that you should reverse proportionate ITC. No, nothing like that. Secondary discounts. The secondary discounts will not have any impact on the availability of ITC as well, because tax liability itself will not be reduced. There will be tax and there will be ITC also. No need to worry about. So simple samples and free gifts if you are giving, for that if you buy something, no ITC. Buy one get one free will not have any impact on your ITC. Discounts also will not have any impact on your ITC. So no reversal, nothing is required. So that is what the concept. Now if you see 17 subsection 1, 2 and 3, see nothing but it is, sir, when you are buying something for business purpose, okay, you can take ITC. But if you are buying that and using for non-business purpose, you cannot take ITC. Sir, I am buying it for business purpose, but to provide taxable outward supplies including zero rated supplies, then I can take ITC. That means, you know, zero rated supplies are nothing but exports and supplies made to special economic zones. For this purpose, if I am buying, I can take ITC. But for providing exempt supplies, if I am buying, I cannot take ITC. Please understand, for providing exempt supplies, if I am buying something, I cannot take ITC. That is what the concept. Okay. So I repeat, if you are buying something for business purpose to make taxable supplies including zero rated supplies, you can take ITC. Now you are buying something for providing exempt supplies, then you cannot take ITC. You are buying something for providing RCM supplies, you cannot take ITC. You are providing buying something for providing nil rated or wholly exempt supplies, then also you cannot take ITC. Now the problem here is, sir, if you buy that and use it exclusively for taxable supplies, exclusively for exempt supplies, exclusively for business purpose, exclusively non-business purpose, yes, we have an idea. But sir, what if we use it commonly for some taxable, some exempt supplies? I am buying a plant and machinery, using it for both taxable supplies as well as exempt supplies. I am buying some inputs, using for taxable supplies also, exempt supplies also, some goods even for non-business purpose also. What if you are doing that way? Exclusively means, yes, we can understand, take ITC or don't take ITC. But what if you are using it for both common purpose? Then what we should do? That is where rule 42 and 43 comes into picture. Okay, so apportionment of credit, if you see, as per the usage, see, you are buying some input services and capital goods, and for what purpose you are buying them. If the breakup is available, then fine. Whether to take ITC or not to take ITC, we can take a decision. What if the breakup is not available? What if the breakup is not available? Sir, with respect to inputs, input services, capital goods, we are commonly you buying them and commonly using for taxable supplies, exempt supplies, non-business purpose, all this stuff. There only rule 42 and 43 will come into picture. Rule 42 deals with common purchases, inputs and input services used for both making taxable supplies also, exempt supplies also. And rule 43 talks about buying capital goods using for both taxable purpose also, exempt purpose also. So that way, so if the breakup is available, the data, this is exclusively used for this is exclusively used for that, then fine. But if that is not available, you are using it for commonly for everything, then how much ITC you can take? That is dealt in rule 42 and 43. So let us go with rule 42 and 43. Very, very, very important rules for you, and most of the students feels this as a little bit confusing, but I am going to simplify it like anything. So let us go with rule 42 and 43. See, before going to rule 42 and 43, we should understand the meaning of exempt supplies. Sir, I am buying something using for both taxable supplies as well as exempt supplies. Then how to apportion the credit, rule 42, 43 talks about that. But what is the meaning of exempt supply is what important here. Sir, the meaning of exempt supply is nil rated supplies we call as exempt supplies. Wholly exempt under GST also we call them as exempt supplies. Non-taxable supplies, RCM supplies, even sale of securities, land and building, warehoused goods are also treated as sale of warehouse goods. We have seen in schedule 3 if you remember. Sir, that is also what treated as exempt supplies. But exempt supplies does not include the interest income. Okay. Except if at all you are a banking company, financial institution, NBFCs, then for you this is added in your exempt supply. Schedule 3 transactions will not be added in exempt supply, except we have seen land and building and warehoused goods. Except those remaining, all schedule 3 transactions will not be treated as exempt supplies. And value of duty credit scripts, whatever has been supplied, that also will not be treated as exempt supplies. Okay, so this is the meaning of exempt supplies. Now here, sir, when I am selling securities, what is the value I should take? 1% of the transaction value, that you take as value here. So when you are selling land and building, the stamp duty value, whatever is there, that you take as value. Warehoused goods, sale of warehoused goods, what is the value I should take? Take the value as nothing but value as nothing but the duty free shops. In the duty free shops, what is the value has been adopted, that you take. Clear? So that is what the concept. Okay, fine, sir. We have understood the meaning of exempt supplies. Now let us move on to rule 42 and 43. So guys, now please understand. Rule 42 is regarding what? Regarding your purchasing inputs and input services. On that you have paid GST. How much ITC you have to take? That is what the concept all about. Listen carefully. Listen carefully. First of all, what we should do? So number one, total how much GST you have paid on that inputs and input services. Let us assume 10,000 you have paid. Okay. So this is what total GST paid. We call it as T. Okay. Ignore the numbers, all that stuff. Just I am doing also show off, but go with the concept instead of T, T1, T2, T3, all that stuff. Once you are clear with the concept, you can remember them also, no issues. Now, sir, what we have to do from this, okay, from this, we have to first eliminate. See, this is the total GST we have paid, correct? On inputs and input services. From that, what we have to understand, how much ITC we are eligible, first we should understand. Sir, remember the word pub. Here, pub spelling is not PUB, here it is PEB. So we should eliminate personal purchases, P. Next, E. For exclusively exempt purpose, what you have used? Purchases which are blocked credit, blocked credit. If you remove all those things, let us assume 1000, 1000, 1000. Sir, balance 7000. These are just imaginary numbers. Balance 7000 is the total amount which should be credited to e-credit ledger, which you are eligible for ITC actually, which you are eligible for ITC. See, now when you are eligible for this ITC, in this there are two things. One is exclusively you have used for taxable purpose, and two, common purpose, common credit. Okay, so there are two things here in this 7000. This 7000 amount should credit to e-credit ledger. I repeat, whatever the GST you have paid on inputs and input services, out of that remove something which is exclusively for personal purpose you purchased, exclusively for exempt purpose you have purchased, exclusively blocked credits. These three elements if you remove, then you will get the balance amount is nothing but the amount which you can take to e-credit ledger. From that, if you remove exclusively for exempt purpose what you have, sorry, exclusively for taxable purpose what you have used, then balance 5000 will be the common credit. Balance 5000 will be the common credit. Now, in this, sir, whatever I have used for exempt purpose, I should proportionately reverse, correct? How will I reverse? 5000 into exempt turnover by total turnover. So from this, I might also used something for non-business purpose. That how much I will do for that calculation, we don't have a proper formula. So 5% of 5000, this much we should reverse. So if anybody asks you how much is to be reversed, this much should be reversed and this much should be reversed. We call it as D1 and D2. Okay, so that is what the procedure. See, I will show you it in a even with a better handwriting. Understand what we have to do. First of all, total GST paid on all inputs and input services, treat it as T. Let us assume 10,000. This is input tax. Okay, from that, remove whatever you have used for personal purpose, exempt supplies and blocked credits. We are calling them as T1, T2, T3. As I told you, pub. Eliminate pub. Pub spelling is not PUB, it is PEB. Personal, exempt and blocked credits. Okay, so you are eliminating. Balance amount is nothing but the eligible ITC which you should take to e-credit ledger, that we are calling as C1. From that, if you remove exclusively for taxable purpose how much ITC is belonging, if you know that data, then balance data is common credit, that is C2. So from that, how much I should reverse? D1 and D2 you should reverse. That means, sir, suppose if my exempt turnover is 60 lakhs, taxable turnover is 40 lakhs, total turnover is 100 lakhs, correct? ITC related to exempt supplies we should reverse. So common credit 1000 rupees into 60 lakhs divided by 100 lakhs will give you proportionately D1, 600 rupees you have to reverse. And common credit, in some questions they won't give anything which is used for non-business purpose. If they don't give anything related to non-business purpose, that means fully we have used it for business purpose only. D2 will not come into picture. D2 will not come into picture. But if you have used something for non-business purpose also, then D2 will come into picture. Clear? How much D2? D2 we don't have any formula here. So they are going with a flat assumption that 5% of common credit. So 5% of common credit is how much? 1000 rupees. So that means how much? 50 rupees will be the reversal. So total eligible ITC is 4000 as we have seen. Here, how much amount we will take to e-credit ledger? 4000 we will take. How much we should reverse from that? D1 and D2. We should reverse 650 rupees. We have to reverse. So eligible ITC is 4000, and from that, if you reverse 650, balance amount will be the 3350. 3350 will be the ITC available for you to set off. That is what the concept of rule 42. Very simple. But understand, conceptually it is very simple. How do you apply this? For this, because this is a revision video, I am not able to solve a problem, but this is one wonderful problem which I have lifted from ICA sources only. Of course, I am not drafting all these things. Okay, so this is one wonderful problem. My suggestion is you try this so that conceptually it will be very much perfect. And of course, I will display the answer also. You just pause the video and take screenshot of this. Try this problem, or the problem is there in the soft copy also. You can just go through that. So how the problem has been solved, all the stuff. If you are comfortable with this, then it is like anything. You are completely thorough. You are completely thorough with the concept. This is the answer, part of the answer, half part of the answer. Take screenshot of this. And then this is another half of the answer. I challenge you, whether you can solve this or not, please check. See, conceptually you are thorough. That's all. The explanation what we have discussed, that much only. That's all. Okay, just people, the faculties will confuse you. T1, T2, T3, T4, all that mugging up and all not required. So you know the concept now. Now you just try to crack it. Okay. Problem is lengthy, but it covers all the adjustments. It needs your patience. That's all. Right. So all the best. Try the problem. You should get this answer. Now let us move on to rule 43. So now rule 43, very important and interesting one, and I have simplified it to the maximum possible way. And of course, let us see that. First of all, see rule 43. Understand, you are buying the capital goods and you are using it for both common purpose. Then how much ITC we should reverse? First, for that, understand, you should avail ITC and then you should reverse ITC. That is what the logic. First of all, let us see what and all ITC I can avail. See, listen carefully. You should be very clear here. You are buying something. You are buying something exclusively for taxable purpose. Yes, you take full ITC, capital goods. You are buying something exclusively for common purpose, taxable as well as exempt. Then full ITC, take full ITC, take full ITC. And now Sir, earlier in past I have purchased it for exclusively exempt purpose, sir, but I have not taken ITC that time, correct? Now that goods, that capital goods is going to be used for common purpose, sir, for both taxable purpose and exempt purpose. On that also you take full ITC. How much ever you have paid GST that time, you take full ITC. Don't worry, we will reverse also, no issues. Okay, so that is the point. Fine. So on these three things you should take full ITC. Now this month you may get a doubt. What if I have purchased earlier exclusively for taxable purpose and now I am using for common purpose? If you have purchased earlier for exclusively taxable purpose, you would have already taken ITC. Now there is no need to take ITC again. So that will not come into picture here. Okay, so this is important. Now this much how like ITC you should definitely take. So we have understood how much ITC we should take, that we have understood. Now the interesting part, the reversal. Sir, how much ITC I should reverse? How much ITC I should reverse? How much ITC I should reverse? Sir, how much ITC I should reverse means, first of all, I should take the total GST paid on capital goods which is used for common purpose. That means I should take total GST paid on the capital goods which are being used for common purpose. See whether they may be new purchases or old purchases. All the purchase of capital goods within 60 months period, whatever you have purchased earlier or this month, everything, entire GST you take here. Earlier you have been using it for exempt purpose, now it has been used for common purpose. Such type of capital goods, on that how much GST you paid, fully take that. And earlier taxable purpose, you have purchased it, paid 1 lakh GST, used it for 3-4 years, now using for common purpose, take that 1 lakh full GST paid here. I repeat here, whether it is a new purchase or a old purchase, new conversion or a old conversion, all these things, on that how much ever GST you have paid, entirely you take here, the total GST on the new purchases, old purchases, new conversions, old conversions, on all those things, the capital goods whatever you have purchased earlier or purchased newly or earlier purchased for exempt or taxable purpose, now being used for common purpose, those all capital goods on that entire total GST paid, now you take it here. That is what we are calling it as TC, total GST paid on capital goods. Now all these capital goods are used for what? Common purpose, correct? Right now they might have purchased earlier or now, or they might have been converted earlier or in this month, but all these capital goods right now, what and all capital goods are being used for common purpose, on that whatever the total GST paid, you take it fully now. That is what we are calling as TC. Okay, now sir, this is entire GST, but this entire GST will give you for 60 months, correct? You know, useful life of the asset we assume in GST is 60 months. So this month how much we have to reverse, that is what we are calculating. So what we will do now, we will take the total ITC availed, so TC, now we will divide it by 60. So we will get a TM, this month related credit we will get credit of related to this month. Okay, am I clear till now? So after taking this for that entire month, how much we have to reverse? So we have understood. See, total GST paid on the capital goods which are used for common purpose, we have taken and we have divided it by 60. So we have understood for that month how much it is related, total common credit. So we should reverse how much ITC out of the common credit, whichever is related to exempt turnover, we should reverse, correct? So we should reverse that monthly credit into exempt turnover by total turnover. So proportionately that much amount you should reverse. That is what we are calling as TE. Okay. So I repeat again, sir, simple, nothing but very simple here. What we should do right now, whatever the capital goods are being used for common purpose, you take, no matter when they have purchased, no matter when they have been converted. Okay, take all the capital goods which right now are being used for common purpose, on that how much ever GST paid, that is common credit. Okay, because on that you should have already taken ITC, conversions, purchases, all this stuff. Now from that divided by 60, that will give you common credit for this month, common credit for this month. So when you take that, sir, common credit for this month, there is taxable purpose also, exempt purpose also. How much ever related to exempt purpose, we have to reverse that, correct? So what we will do now, sir, reversal amount will be that monthly credit into exempt turnover divided by total turnover will give you the answer how much you should reverse. That is what we are calling as TE. Clear? Now, if at all there is one more interesting point here, there will be one more extra reversal for you. What is that extra reversal now? If at all earlier you have used it for exclusively exempt purpose, purchased it for exclusively exempt purpose. Now you have converted. This month you have converted. This month the conversion is happening. This month if you have converted, then immediately here you have taken full ITC if you remember. Earlier exempt, but now you are using it for common purpose. This month take full ITC, you have taken full ITC, but sir, there is a GST portion related to the period where you have used it for exempt purpose, correct? So what we have to do, we should reverse that also. The total GST paid earlier 1 lakh, now you have taken full ITC this month, because in the first point I taught you, first take full ITC, then we will do reversal, like that I told you, correct? So you have taken full GST paid as ITC, but there is a portion of it which you have used during exempt supplies, where you have exclusively used that capital good for exempt supplies. So you should see how many quarters or part thereof you have used that capital good for exclusively exempt supplies. Imagine, sir, 1 lakh, I have used it for 4 quarters, sir, exclusively for making exempt supplies. That capital goods I have used, sir. Then out of that 1 lakh, 4 quarters into 5%, that is 20% belongs to exempt area, exempt period. So that much you should reverse now. 1 lakh into 20%, 4 quarters into 5%, that is 20% you should reverse. That is 20,000 you should reverse. Clear? This is another reversal. So in all questions this may not be there. Sir, there will be TE with respect to capital goods. TIE sometimes it will be there, it will not be there based on this. Okay, so hope it is clear for you. There is a small problem also here I have attached for you to solve. So you can just solve this problem. And see, rule 42, 43 problems, whatever I have shown to you, they are nothing but ICA study material, book back questions. You can go through that also if you have ICA study material with you. Okay, so this is the point. And for this, you should try. See, simple, I repeat, what is that we have purchased, for what purpose we are using. Okay, you can avail ITC when you can avail. This month you are buying something for fully taxable purpose or fully common purpose, or earlier I have purchased it for exempt purpose, now using for common purpose. All these things will be ITC for you this month. So this month you will take ITC only on fresh purchases and one fresh conversion from exempt to common, that you will take ITC. But coming to reversal, what we will do? Coming to reversal, we will take all the capital goods right now which are being used for common purpose. Maybe purchased earlier or now, maybe converted earlier or now. So all the capital goods which we are using right now for common purpose, on that whatever GST paid, we will take it as common credit. And then we will divide it by 60, and then we will proportionately go with exempt turnover and total turnover, and we will reverse. So that is what we have to see. So with that conceptual clarity, go with this problem and then check the answer. Okay, so the answer is also attached below. As I told you, ICA study material problem only, book back question, you can just go through that, you will get that, right? So just try it on your own sincerely, so that conceptually you will become very much stronger. So this is what all about rule 43. So guys, understand first of all, sir, with respect to rule 42 and 43, the reversal of ITC will be done on monthly basis. So on monthly basis, you will be doing this on the monthly term. Once the year is over, you should calculate in it entire yearly turnover, all that stuff. Any differences are there, you should deposit that. Any shortfall is there, then you can take that ITC. That means what? For example, this reversal you have made, then you can re-avail that ITC. Or you have less amount of ITC, then you can reverse again that ITC, whatever. Okay, so that is what all about that. So please keep this in mind. This is rule 42 and 43. So the next one is 17 subsection 4. You know, 17 subsection 4 is nothing but for the banking companies, financial institutions, and NBFCs. We are coming up with an option where, sir, they are providing taxable supplies and exempt supplies. They can go with 17 subsection 2 along with rule 42 and 43 and reverse the ITCs, all that we have calculated just now. So in that way they can proceed, or we want to make their life simple, easy. So in 17 subsection 4, what we are doing, we are coming up with an option to them. What is that option? Simple. Whatever you purchase, you take full ITC. We will not question whether it is used for taxable purpose or exempt purpose. Sir, is it true? Yes, but there is a small twist in the story. What is the twist in the story? Now, you should reverse 50% again at the end of the month. That means what? Flat 50% available. So simple, remember 17 subsection 4 if you are going with that. Sir, banking companies, financial institutions, and NBFCs, for them, three things. Whatever blocked credits you purchase, no ITC, 0%. Other purchases you can take 50% ITC, and if at all you are buying from your own distinct persons, 100% ITC. So 0, 50, 100. That way you remember. That's all. That is what section 17 subsection 4. So if you want to follow this option, banking company, financial institutions, and BFCs, you can follow this option. Or if you want to go with 17 subsection 2, you can go with 17 subsection 2 as well. But option once exercised will be valid for the entire financial year. So for entire financial year, one option only available. So that is what this 17 subsection 4 all about. There's a small question for you. You can just go through this. So with this, we are done with 17 subsection 4. Now the very important one, you know how to set off the ITC balance. Yes, the very important one, to set off the output tax with the input tax. So what are the rules for setting off that ITC balance? As you know, sir, IGST balance, ITC, CGST, ITC balance, SGST, ITC balance, we have to use them for set off of our output tax liability. Now the first agenda, you know, everybody knows that the first agenda is IGST, ITC under 0. Correct? That is what our first target. So for that, what we can do, sir, we have to use it. First of all, please understand these things. IGST, CGST, SGST. These like are your 3 pockets. So you have money in 3 pockets. So you can take money out of that and spend that money. But remember, you cannot transfer the money from one pocket to another pocket. Please understand that. I repeat, there are 3 pockets, sir, IGST, CGST, and SGST. And from those 3 pockets, you can take money. You can take money only for spending, but not for transferring from one pocket to another pocket. That means the ITC from this account you cannot bring to this account, from this account you cannot bring it to this account. Please understand that. Sir, you can only use them. You can only use the balances in ITC, but you cannot transfer that from one ITC head to another ITC head. Please be very careful. Okay. So IGST ITC balance, sir, IGST ITC balance, first you should be using it for IGST payable. Okay. After using it for IGST payable, then what will happen? Sir, if at all any balance is there, CGST and SGST in any order, in any proportion, you can use it. But here, sir, when they say any order, any proportion, you should be very careful. They may say that any order, any proportion, but in the question, in the exam, not ask you the question where net GST payable. The question they will ask is net minimum GST payable in cash. That means this step, whatever is there, is going to be very crucial. You should use this ITC balance effectively in such a way where your utilization is so effective, the cash outflow will be as less as possible. That is very important. Okay. So I repeat, IGST ITC balance, you should first make it 0. Till then you cannot touch these accounts. Hope I am clear. Okay, so first IGST ITC balance. If you see IGST payable, sir, IGST payable, IGST ITC balance you can use for IGST payable. Still we have balance, anything left out, use it for CGST or SGST in any order, in any proportion. The law says any order, any proportion, but you should use it effectively. Next, finally, still any balance is there, sir, in IGST ITC, then you will carry forward. Understand, in the answer, if you are listen carefully, this is one common mistake what you do. IGST ITC balance carry forward should not come. If at all it is coming, still your answer is right, provided there are 2 things. One is all the liability should have become 0. IGST ITC carry forward, if you get in the answer, that means all the liabilities became 0. And you have not touched or you have not utilized CGST, SGST balance. If these 2 conditions are satisfied, then only your answer is correct. Because without making this 0, you cannot use these accounts. Correct? So please understand, if you get IGST ITC carry forward, that means liabilities are fully over, and CGST ITC balance, SGST ITC balance, you have not placed this. Okay, that should be the case. Right. Now coming to the point. Sir, IGST ITC balance, we made it 0. Imagine that way. Then what we can do? We can start using CGST ITC balance. CGST ITC balance you can use it for what? CGST ITC balance you can use it for CGST payable first. Till any balance is there, IGST payable. Till any balance is there, then carry forward. But you cannot use it for SGST payable. Same way, SGST ITC balance for SGST payable. Till any balance is there, IGST payable. And please understand, SGST ITC can be used for IGST payable only if CGST ITC credit is not available, balance is not available. But if you follow the sequence what I am doing, that is why when you are writing the answer, in the answer the format should be particular amount, and first you should take CGST, SGST, so that you will follow all these conditions. So IGST first to make it 0, IGST ITC first to make it 0, then only come to CGST ITC. Once fully completing CGST ITC rules, then come to SGST, then automatically will be following this condition. That means simple, if there is already CGST ITC balance to help IGST payable, then why you are going to help him like that? For SGST the question will come to picture. So SGST can help IGST payable only if CGST balance is over. Hope it is clear for you. Am I clear? Right, so that is what the point. Fine, so those are the rules here. So I'll just show you one problem how to do this. See, understand the approach, how to set off actually. See, imagine these are our output tax and input tax. Clear? So what is our first target? What is our first target? So our first target is to make this IGST ITC balance 0. For making it 0, you should use it for IGST payable. But here IGST payable is just 54,000, but ITC is 79,000. So IGST payable becomes 0. IGST payable becomes 0. But ITC doesn't become 0. So 79,000 minus 54. So still it will be like 25,000. Your target is to make it 0. Now understand, you have 25,000 in hand and you can use it for CGST or SGST payable in any order, any proportion. But you should not do that. You should see who actually, see, you have 25,000 amount in your hand. You should see who actually needs your help. You should see actually who needs your help. Sir, who needs your help? If you see, CGST payable is 72,000, ITC is 75,000. That means it has 3,000 extra money. It doesn't need anybody's help. But if you see, SGST 72,000 payable but 18,000 ITC. So that means it needs the help of 54,000. Still it has a shortfall of 54,000, if you understand. That means SGST is actually waiting for somebody to help. This way if you do, you will never go wrong. Yes, IGST ITC balance extra you have in your hand. Sir, that amount to whom you can give, to whom you can help, to whom you can set off. See whether CGST needs help or SGST needs help. If they need help, how much they need. So that way you should proceed. Sir, here 25,000 I have, but SGST needs 54,000 help. CGST doesn't need any help. So you should not use that amount for CGST payable. If you use this 25,000 for CGST payable, that means you are helping a person who actually doesn't need any help. So automatically you are increasing your cash liability. Are you understanding that point? So use that 25,000 for paying this 72,000. Fully you help. So here 47,000 payable will be still remaining. This became 0. Your first target achieved. See, till this became 0, I did not touch these people. I did not use this CGST, SGST, ITC balances. So now IGST, ITC balance became 0. Now what I am doing? Sir, I am using CGST, ITC for CGST payable. The CGST payable 72,000 is there, that becomes 0. Now this CGST, ITC still 3,000 I have. But that CGST 3,000 ITC, what you can do? You can use it for IGST payable, but IGST payable is already 0. So what you can do now, sir? You cannot use it for SGST payable, you know. So it is only it can be only carried forward. That is what the concept. Okay, it can only be carried forward, right? That is the concept. Fine. Now coming to SGST, sir, SGST ITC 18,000 is there, but liability 47,000. So if you reduce that, still 29,000 payable will be there. This became 0. So this will be the final answer if you see. Correct. So CGST carry forward 3,000, SGST payable 29,000. This will be the case. Hope it is clear for you, right? So that is what the point. Next, fine. One more small way, like I'll help you to understand the procedure actually, how to just develop the thought process. See, again same story. IGST you have 1,300 ITC, but payable 1,000. Payable becomes 0, but ITC still 300 is there. Your target is to make this 300 0, IGST, ITC 0, correct? Your target is to make that 0. Now, understand, you have 300 rupees in your hand and you have two parties to help in front of you. Sir, one is CGST, the other is SGST. CGST needs how much help from you? CGST needs, see, output tax is 300, input tax is 200. It needs 100 rupees help. Same way, SGST also 300, payable is there, 200 ITC is there. it needs 100 rupees help. Are you understanding the point? So in such case, sir, what will happen? Both of them needs 100 rupees help, and you have 300 rupees in your hand. Correct. So when you have 300 rupees in hand and both of them needs 200 rupees help, what you should do? We should not go on fully help. CGST 300 you take it, SGST 300 you take it. Any order, any proportion like that you should not do. Please understand. You have 300 in your hand and two of them standing in front of you, both of them asking 100 enough. Then first you should help both of them 100 minimum. That means you are effectively utilizing your money. Then extra 100 rupees is there, no, you give to anybody, it will not change the answer. So please understand here the concept is not about giving them equally. 300 you have and giving them equally is not the concept. Please don't misunderstand that way. Sir, 300 I have, I'll give both of them 150. No, that is not the concept. See how much help both of them need. That much minimum, if you are able to help, that is more than sufficient. No sir, I only have less money, then there is no problem. However, the answer will be perfect. So please understand, develop this thought process, who needs how much help. So I felt like this fellow needs 100, this fellow needs 100, so for both of them we are helping 100. So still I will be having 100 rupees. Now this full 100 rupees you help to CGST or you help to SGST, it doesn't change the answer. So I made first in queue CGST standing, I paid to him. So IGST ITC became 0. Now I can go with CGST CGST 100 rupees carry forward, SGST both became 0. Clear? Guys, I repeat, when you have IGST ITC in your hand, you should see which fellow needs actually your help. Accordingly, you help both of them and then settle the liabilities. Okay, that is how you should develop the thought process. Hope it is clear for you. Right? But first your agenda is making IGST ITC balance 0. Till then you cannot touch CGST and SGST accounts. Clear? So that is what the concept. You can try this example. So the next section is nothing but section 18, actually all about we are going to see with. So section 18, if you see section 18, mainly first what I'll do, I'll discuss section 18 subsection 1, 4 and 6 first, then we'll go with subsection 3. Subsection 2 incidentally along with subsection 1 I'll discuss. So these are first one set of sections, then we'll go with subsection 3 separately. Now coming to the point, sir, what is section 18? Section 18 is all about, section 18 is dealing with ITC in special circumstances. I'm talking that dealing with ITC, it is not availing ITC or reversal ITC. So both are there in section 18. You can avail ITC as well as you can reverse ITC. So first of all, section 18 subsection 1 we are going through. So section 18 subsection 1 is talking about availing ITC in special cases. What are the special cases where you can avail ITC as per section 18 subsection 1? So there are 4 cases, clause A, B, C, D. A is all about you are becoming liable for registration and you are applying for registration within 30 days, or you are taking voluntary registration, or you are coming from composition scheme to normal scheme, or your exempt supply becomes taxable supply. See, so long in past you did not take ITC because of various reasons. Either you are not registered, or you are under composition scheme, or making exempt supply. Now, sir, you are coming out of that and you are going to pay output tax. Because of that, what we are doing, whatever the stock you are having, inputs or capital goods, whatever you are bringing now into taxation net, we are going to give ITC. Here I repeat, clause A and B are one category, C and D are another category. What is that category, sir, if you ask me? Sir, in clause A and B, you are becoming liable for registration and immediately preceding date, closing stock. The date of becoming liable for registration is that immediately preceding day. Yes, this is the immediately preceding date of the date of becoming liable for registration. On that date, whatever is the closing stock you're having, inputs in stock or inputs in work in progress, inputs in finished goods, on all these things they will give you ITC, but no ITC on capital goods. Please understand that the important thing is here, no ITC on capital goods. Clause A and B, where you are becoming liable for registering and where you are going for a voluntary registration, both the cases, here you will take ITC. You are eligible for ITC only on inputs, not on capital goods. So the only difference is, sir, here the effective date is like the date of becoming liable for registration, immediately preceding day, the closing stock. Voluntary registration, the date of grant of registration certificate, immediately preceding day of date of grant of registration certificate. So on that date, whatever the inputs are there with you, maybe in stock or work in progress or finished goods, on that we will give you ITC, that is clause A and A and B. So A and B one set over. Coming to clause C and D. Clause C and D, sir, so long you are under composition scheme, now you are coming under normal scheme. You are coming out of composition scheme. The date when you become ineligible for composition scheme, immediately preceding day, whatever the inputs lying in stock, work in progress, finished goods, on that you can take ITC, and also you can take ITC on capital goods. That is why I told you clause C and D are different. What is the difference in clause C and D with respect to A and B? Na? In A and B, you are not registered, now going for registration. C and D, you are already registered, but composition scheme to normal scheme you are coming, or exempt supply is becoming taxable supply. Hope it is clear. And one more thing, and one more difference. One more difference is, sir, in clause A and B, you can take ITC only on inputs, A and B. In C and D, you can take ITC on both inputs as well as capital goods. So that is what the difference, another difference. Now here the point is, sir, if at all it is inputs in clause A and B, you can take ITC easily, proportionately. For example, when you have purchased 10,000 kgs, you did not take ITC. But now when you are coming out of that, like you became liable for registration, took registration, or voluntarily you took registration, now you have 2,400 kg raw material pending with you, lying with you, maybe in stock or inputs or work in progress or finished goods, all that stuff. Now that 2,400 kgs proportionately you will take. But sir, what about capital goods? In class C and D, you are also eligible for capital goods, correct? You can take ITC on capital goods. Sir, how much ITC you can take? Now, please understand, if you purchase today, when you are under normal scheme, registered under GST, using it for taxable supply, everything, you buy a capital goods, I will give 100% ITC. But why am I giving you that 100% ITC? Because I am believing that you will use that asset for 5 years at least. That is the standard assumption in GST. The useful life of the asset is 5 years. So I will give you 100% ITC, assuming that you are going to use it for 5 years. But the problem is, you have already used it in composition scheme, or you have already used it under exempt supply. In such cases, sir, how much ITC I should give you? I cannot give you 100% ITC. So what I will do is, sir, 100% GST paid, whatever you have paid, total GST paid, minus, sir, I will reduce 5% of every quarter you have used in composition scheme, you have used in exempt supply. Sir, that I will reduce, and balance amount I will give you. That means what? Simple. Total GST paid minus 5% per quarter or part thereof. So every quarter or part thereof also will be treated as one full quarter. So that much we will reduce, and on balance amount we will give you as ITC. Now see, for example, here you have purchased the capital goods on December 28th and paid GST 1,80,000. But you are under composition scheme, and you have opted composition scheme for financial year 18-19 and 19-20, and on 6th October you are coming out of, because your aggregate turnover has exceeded the threshold limit, you are coming out of composition scheme and coming into normal scheme. How much ITC you can take on capital goods? Means we should see how many quarters you have used. See, if you see, this is coming in quarter 3 financial year or calendar year, whatever you take, answer will not change, so don't worry about that. So quarter 3, so October to December quarter, this is happening in 18-19. So in 18-19 Q4 also you have used, and this event is happening in October to December quarter of 19-20 financial year. That means Q1 there, Q2 there, and Q3 there. So total 5 quarters you have used. 5 quarters you have used. Are you able to understand? You have used Q3 and Q4 in 18-19, and Q1, Q2, Q3 in 19-20 financial year. So I repeat, whether you take it as calendar year or financial year, answer will not change, because the quarters are always same. Okay. So now 5 quarters you have used. So total GST paid 1,80,000 minus 5 quarters into 5%, that is 25%. If you remove, then that much amount you can take as ITC. That is what the answer. If you see, 1,80,000 minus 25%, 1,35,000 will be the ITC. Are you able to understand? Okay, so that's all. That is how you calculate. Hope it is clear for you. So for this, there is a procedure in Rule 40, whatever has been prescribed. Sir, what you are doing when you are taking ITC on capital goods, that we have already discussed how we will calculate that. And sir, form GST ITC 01 within 30 days should be filed from the date of becoming eligible for ITC under 18 subsection 1, maybe under subsection 1 clause A, B, C, D, whatever it is. You should, for taking this ITC, you should file a form here, GST ITC 01. That's all, within 30 days of becoming eligible for ITC under this particular section. And in that, you should give the details of inputs, capital goods, what and all you are eligible. And suppose if at all that amount totally CGST, SGST, IUT, GST, IGST all put together, whatever you are claiming ITC, if it is exceeding 2 lakh rupees, then you should get it certified by the chartered accountant or cost accountant who are in practice. Okay, I repeat, entire ITC, eligible ITC. Okay, if at all it is exceeding 2 lakhs, inform GST ITC 01, then you should go for the certification from practicing chartered accountant or cost accountant. That is what the concept. Okay, so now that is what rule 40 says. So rule 40 is this procedure for calculating all that stuff. So we have calculated. So I repeat, 18 subsection 1 is all about availing ITC in special cases, A and B one set, C and D another set. Liable for registration, voluntary registration, composition scheme to normal scheme, exempt supply becomes taxable supply. Here only inputs, here both inputs and capital goods. Here not registered, now registering. Here already registered, now paying tax. Okay, so that is the case. So here inputs, both all the 4 cases inputs, proportionately you can take ITC. Capital goods in the last 2 cases, clause C and D, how you will proceed? Rule 40. Rule 40 says total GST paid minus 5% per quarter or part thereof used. On that you can take ITC. So that is what we have seen. Now, sir, the interesting part is if you want to take ITC under 18 subsection 1, just now as we have discussed all the 4 cases, clause A, B, C, D, all this stuff. If you want to take ITC under those 4 clauses, any of those 4 clauses, the time limit to avail ITC is 1 year from the date of invoice. That means the 16 subsection 4 will give you actual time limit for availing ITC, that is for normal cases. But 18 subsection 2 will give you the time limit to avail ITC. If at all you are claiming ITC under 18 subsection 1, then you should definitely follow 18 subsection 2 time limit. That means in short, 18 subsection 1, if you want ITC on inputs and capital goods, you should have that purchase within 1 year. Only for within 1 year purchases of inputs or capital goods, you can take ITC. More than that, you cannot take ITC. Am I clear with that? If you see here in this example properly, I have made sure that the purchase date and this exit date from composition scheme are falling within 1 year if you check. Okay, because of this particular logic of 18 subsection 2. Okay, fine, that is there, and there is an example also, you can just go through that. And next, as I was talking, let's just finish 18 subsection 4 and 6. 18 subsection 4 is nothing but simple, understand. 18 subsection 4 is nothing but, see, sir, when you are coming from composition to normal scheme, I am giving you ITC. When your exempt supply becomes taxable supply, I am giving you ITC. Then, suppose if reverse situation happens, you are coming from normal scheme to composition scheme, or you are going from taxable supply to exempt supply, then you should also reverse the ITC, correct? So this is exactly opposite scenario for 18 subsection 1. Exactly opposite scenario for 18 subsection 1. So here what you can do, sir, when you are going from normal scheme to composition scheme, or your exempt supply, taxable supply becomes exempt supply, sir, whatever the inputs and capital goods you are having, please reverse the ITC. Inputs proportionately will reverse ITC. If it is capital goods, nothing but there you have taken ITC, availed ITC on quarterly basis. Here you have to reverse ITC on monthly basis. So simple, what we will do, sir, we will see how many months the capital goods is used. For example, Mr. Anil has purchased the capital goods and availed ITC 60,000. Now, the 60,000 I gave you ITC, assuming or believing that you will use this capital good for 60 months. Now, what happened after 3 years, 7 months, and 22 days? Sir, what has happened? Not told. Okay, let us assume he's coming out of composition scheme. He came out of composition scheme. So, Mr. Anil came out of composition scheme. Came out of composition scheme. So, we will take 3 years, 8 months as used. So in 5 years, 3 years, 8 months are over, means that means still 1 year and 4 months. That means 16 months is still pending. So 60,000 into 16 divided by 60. That means 16,000 should be reversed. Proportionate ITC for the life of the asset. Life of the asset is 60 months. You see how many months still is left. For that you should reverse the ITC. Okay, for that you should file a form GST ITC 03. So that is what the concept. Hope you are clear with that. Okay, so with this we are done with 18 subsection 4 also. Simple, 18 subsection 4 is nothing but exactly opposite scenario for section 18 subsection 1 clauses and D. Hope it is clear. Okay, now 18 subsection 6. Let us go with 18 subsection 6. What is 18 subsection 6? So 18 subsection 6 is nothing but if you have availed ITC on any capital goods, that capital goods is being sold, that capital goods is being supplied. In such cases, what will be the reversal of ITC? Simple, sir. The law says, you see, exactly ditto what we did in 18 subsection 1. Their total GST paid minus 5% per quarter or part thereof. There you are availing ITC for the first time. So total GST paid minus 5%. Here you have already availed ITC, you have to reverse the ITC. So total ITC availed earlier minus 5% per quarter or part thereof of the usage. That will be the calculation. You should be technically very much clear about the wordings what you are using. Please understand that. There total GST paid minus 5% per quarter. Here total ITC availed minus 5% per quarter or part thereof. Okay, and you should compare it with sale price into GST rate, whichever is higher, that much you have to reverse. Please understand that. Okay, so now see, for example, Mr. Sanbir Kapoor has purchased a capital goods on 2nd June 2023. This is happening in Q1 23-24 financial year. Purchase price 100 lakhs, GST 18 lakhs. That means what? GST rate is 18%. Okay. Now, sir, he is selling this capital goods on auspicious day 14th Feb 2024. This is also falling in 23-24 financial year for 70 lakhs. Compute the reversal of ITC. So you tell me here, how many quarters we have used this? 4 quarters we have used. That means for that 4 quarters taking ITC is correct. Balance quarters you have to reverse, correct? So total ITC availed 18 lakhs minus 4 quarters into 5%, that is 20%. If you eliminate balance amount, that one you should compare with sale price 70 lakhs into GST rate 18%, whichever is higher, that much you have to reverse. So 14 lakh 40,000 or 12 lakh 60,000, whichever is higher. Sir, which is higher? 14 lakh 40,000 is higher, so that much we have to reverse. Clear? Hope it is clear for you. So 18 subsection 6. So with this we are done with 18 subsection 6 as well. So 18 subsection 1, 4 and 6, if you see, we have discussed in them. In them, capital goods, we are, see, 18 subsection 1 we are availing ITC, subsection 4 we are reversing ITC, subsection 6 also we are reversing ITC. So that is what the concept all about. Hope it is clear for you. Fine. So with this we are done with 18 subsection 6. Let us move on to 18 subsection 3. So if you see 18 subsection 3 is nothing but when you are selling your business, the business may be transferred because of like merger, amalgamation, demerger, etc., whatever it is. But because there is transfer of business, what the transferor can do is the transferor can transfer his unutilized e-credit ledger balance to the transferee who is buying his business. Okay, so just like how do you transfer money from your bank account to another's bank account, here when I am selling my business to you, from my e-credit ledger, whatever unutilized balance is there, that I can transfer to you, provided there is a sale of business with a provision of transferring all the liabilities. Okay, so transferor from his e-credit ledger, he can transfer to his e-credit ledger balance the unutilized amount. And as I repeat, the condition is the sale of business should be the condition that transfer of all the liabilities. That is the condition which is very important. So what is rule 41A talking about? Please understand, in rule 41A what they are trying to tell is that in one state I have one registration but 2 different place of businesses. Now what I am doing for for additional place of business, I am taking a new registration. That means in the same state I had one registration earlier, now I am taking a new registration. For the new registration, whatever you have taken the place, for that new registered unit you can transfer the ITC balance proportionately. For example, understand, see, I am in Tamil Nadu, I have one registration but 2 branches. One is in Chennai, the other is in Coimbatore. Okay, one is principal place of business, the other is additional place of business. Now what happened? So for Coimbatore, I took a new registration. So whatever the ITC already lying in Tamil Nadu, the earlier old registration ITC balance, that I can now pass on to even Coimbatore registration a small amount. How much amount? With respect to the proportionate value of assets the Coimbatore branch is now having. Okay, so that is the option here. And now, sir, when you are splitting the ITC, when you are distributing it in the ratio of the value of assets held by that Coimbatore branch, all the assets should be considered irrespective of the fact whether ITC has been taken on that assets or not. That is the important thing. Clear? So I repeat, whether the assets, business assets on which whether you have taken ITC or not, it doesn't matter. You can take all the assets and in the ratio of how much assets each branches are having, in that ratio you can split and pass on the ITC balance, transfer the ITC balance to the newly registered unit in the same state. Now I repeat, newly registered unit in the same state. Now with respect to demerger here, They have given a way how do you do this. Actually, so demerge also, we are splitting the businesses and there is demerged entity coming into picture. The existing entity, let us assume Vivar Private Limited, we are dividing into PVV and VV. Okay, sorry, Vivar than VV. So that way demerged entity, so we can split the ITC balance also. Here they have given how do you do that, all that stuff, the distribution etc. of ITC. This is applicable for all form of business reorganizations, not only for demerger. So what they are trying to tell here is, sir, when you are splitting that ITC or transferring that ITC, what you should do now, when you are calculating the value of assets, value of assets should be taken state wise, not pan India wise, first of all. Okay. Second one, sir, you can split this only when both the entities, the transferring entity and the transferee entity, should be in the same state. Then only you can split that. You can transfer the ITC balance. Now see, for example, Vivarth Private Limited is having 1000 crore assets. When you are taking this 1000 crore assets, please understand, you should take all the assets, whether we have taken ITC on them or not, it does not matter. Okay. Now, sir, in two states we have the locations, sir, Madhya Pradesh and Uttar Pradesh. In Madhya Pradesh we have 600 crore worth assets. In Uttar Pradesh we have 400 crore worth assets. Sir, in Madhya Pradesh, if you see, now I am splitting Vivarth Private Limited into Vivarth Limited and Vivarth Private Limited and VV Private Limited. Now I should see within Madhya Pradesh, how much assets are split between each of them. It is Vivarth and VV. 300 crores has been split. That means 1:1 ratio. Now you divide that ITC balance of Vivarth Private Limited between Vivarth Private Limited and VV Private Limited in 1:1 ratio within Madhya Pradesh. So coming to Uttar Pradesh, we are splitting the assets in, like, Vivarth Private Limited will be having 300 crores assets and VV Private Limited will have 100 crore assets. So now 3:1 ratio they are dividing the assets, correct? So ITC balance also you should divide in 3:1 ratio. Clear? So that is what the concept. Fine. Till now it is okay, sir. There are some other conditions also. What are the conditions? Now if you see, sir, when you are applying this ratio 1:1, 3:1, we have calculated, no? So that ratio 75%, 25% or 50%, 50%, that way, this ratio should be applied on the total ITC balance, not for each CGST, SGST, IGST, not required. For total balance, if you apply the ratio, that is more than sufficient. And how much ever is there in each head, for example, in CGST you have 10 lakhs, you can transfer maximum 10 lakhs only to the new entity, not more than that. But total, if you see, total percentage should match. Okay, that is the point. Now, sir, if you see a small example here for explaining that concepts, sir, we have branches in Delhi and Madhya Pradesh, sir, and in Delhi and Madhya Pradesh we are splitting the entity, so demerger is happening. And if you see, the new entity is going to get 70% of the assets. That means old entity will get 30% and new entity will get 70%. If you see, total ITC balance already we are having is 10 lakhs, 10 lakhs, 30 lakhs, totally 50 lakhs we are having. In this, 70% will go to the new entity, 35 lakhs. So here the percentage of 70% should be applied on total ITC balance. Individually we need not check 70%, 70%, 70%. Totally out of 50 lakhs, I should transfer 35 lakhs. 70% I should transfer. So from that, CGST 10 lakhs is their full 10 lakhs I can transfer. SGST 10 lakhs is their full 10 lakhs I can transfer. If you have CGST 10 lakhs, you cannot transfer 12 lakhs. Okay, please understand that. And sir, 30 lakhs I have IGST, I will transfer 15 lakhs. Totally, if you see, 35 lakhs, it is matching 70% of 50 lakhs. It is matching a SANUA. So that is sufficient. Headwise, you need not apply that ratio. So only thing, number one, headwise you need not apply the ratio, total ITC balance you apply that. Number two, headwise what you should see, in one head if you have 100 rupees, you can transfer only 100 rupees there, not more than 100 rupees, correct? Here I have 10 lakhs, can I transfer 12 lakhs to this fellow, new entity? No sir, that is not possible. Okay, that is another point. So here if you see again, Madhya Pradesh, the demerged unit is getting 40% assets and the old unit is having 60% assets. So if you see here, total ITC balance is 70 lakhs. From that 40% you can transfer, means 28%, sorry, 28 lakhs you can transfer, correct? Each head, how much ever you want, you transfer based on whatever is available. In each head, 25 lakh, 25 lakh, 20 lakh is available. You transfer how much ever you want from that head. Okay. But total, if you do, it should match 28 lakhs. So here what they are doing, out of 25 lakhs, if you see, 3 lakhs we are transferring, 25 lakhs, 5 lakhs we are transferring. Out of 20 lakh IGST, 20 lakhs fully we are transferring. Total, if you see, 28 lakhs transferred. So total your wish. Each head, sorry, total you should match the percentage. Each head your wish. How much ever you want to transfer, you can transfer. That is what rule 41A. And here, if you are seeing, sir, that ITC balance on which date I should consider, sir? ITC balance you should consider on the date of filing GST ITC 02, and ratio you should consider based on the assets lying on the appointed date of demerger. Appointed date of demerger. Hope it is clear for you. So that is what rule 41A. If you want, you can just take this example peacefully by pausing the video. So the next section, if you see, it is nothing but section 20, that is input service distributor. You know, input service distributor is a concept where, sir, there is a central office which is receiving the billings, all that stuff, and from that we are distributing the credit. So the bills are related to all the other branches, all that, sir, all the other branches, and that billing is done at central office. The central office is receiving various inputs, capital goods, input services in its name, but the outward supply is not there from that administration office or central office, whatever it is. So the input is getting accumulated at the central office, which is of no use. So that input services, whatever they have received on that credit, this central office can distribute to the branches for which these input services are specifically related to or commonly related to. That is what the concept of input service distribution. So we receive input services in central office in the name of head office or administration building, whatever it is, and we cannot take ITC of that. So we are transferring it to the branches where output tax is generated, and the services which we are receiving at administration building or central office related to the branches. So related to the branches, we are distributing to those branches. For that, we need first of all ISD registration separately. It is not general registration. Even though you have a normal registration, you should take an ISD registration separately for doing this. Number one. Number two, this is only available on input services. Okay. Number three, this is distributed to the branches to which it is already related or actually related. The input service is actually related, no matter whether that branch is eligible for credit or not, or they are providing exempt supplies, or that it doesn't matter to us. Our duty is to distribute the credit. Let them do what they want with that. If they are eligible for ITC, let them take ITC. If they don't, if they are not eligible for ITC, let them not take ITC. Okay, so this distribution will happen for all the branches which are operational during that period. Okay, now see, for example, there is an administration office in Andhra Pradesh which is receiving input services, and further they might be paying CGST, SGST, or IGST, whatever it is, when they are procuring the services, correct? That they can distribute to branches, like the branches are in Andhra, Tamil Nadu, and Karnataka, imagine. So for those branches, they can distribute the credit. Clear? Now coming to the point, sir, when we are talking about the credit, you see, sir, how the credit will be distributed. See, there are three varieties here. First of all, first variety is, sir, the input service may be purely related to a particular branch, sir. What we have received at administration office, this is service related to particular branch. For example, we received input service which is exclusively related to branch in Andhra Pradesh, then transfer the entire credit, distribute the entire credit only to Andhra Pradesh registration. No, sir, it is belonging to more than one branch. Imagine we are receiving an input service which is related to both Andhra Pradesh as well as Tamil Nadu. Then what we will do, sir, we will distribute it to both Andhra and Tamil Nadu, that credit whatever is there belonging in that input service. So that entire we will be distributing only between Andhra and Tamil Nadu, not with Karnataka. Now, sir, how do you distribute that? In the ratio of the turnover in those states. So Andhra turnover and Tamil Nadu turnover, in what ratio they are there? Let us assume here 2 crores, here 1 crore. In 2:1 ratio, we will split that input service credit. Okay, the credit whatever is related to that input. No, sir, input service related to all the recipients. Imagine we have all the branches in Andhra Pradesh, Tamil Nadu, Karnataka, correct? This input service what we are receiving is related to all the three branches. In such cases, what will happen? In such cases, sir, this will be distributed for all the three branches in the ratio of their turnover. Okay, so that is what the concept. Now, please understand there are certain key points here. Sir, if they don't have turnover in the last preceding financial year, how do we proceed? Whatever the last quarter turnover available, in that ratio you should split. That is one important point we should understand. The next one is, as I told you, distribute the credit even if the recipient is unregistered or making exempt supplies. Okay, distribute the credit whether they are eligible for IT, just like you raise invoice on the unregistered customer, etc., etc. Just distribute the credit, raise an ISD invoice. Next, The entire credit is distributed. Whether the opposite fellow is eligible for ITC or not, it does not matter. That is also we have already discussed. Next, sir, when you are calculating the turnover, when you are dealing with both taxable and non-taxable goods, sir, when you are calculating the turnover, exclude the central excise duty, state excise duty, central sales tax, and VAT. So that is what the concept. Am I clear? So these are the key points which we should keep in mind. And how do we distribute the credit? See, when you are distributing the credit, please understand, if the input service distributor is having IGST credit with him, he can transfer IGST credit only as IGST, not anything. Okay. Even though section 20 is permitting that, rule 39 doesn't permit. So simple, understand, IGST can be transferred only as IGST. Okay. Sir, we have CGST credit, sir. ISD is having CGST credit. How they will transfer? If ISD, input service distributor, is having CGST credit, that can be transferred as CGST if that other branch is also in the same state of ISD. For example, sir, ISD is in Andhra Pradesh, branch is also in Andhra, then CGST credit can be distributed as CGST credit. No, sir, ISD is in Andhra, but branch is in Tamil Nadu. Then CGST credit will be distributed to Tamil Nadu branch as IGST. Same way, SGST. Sir, branch is ISD is in Andhra, branch is also in Andhra. Then SGST will be transferred as SGST. No, sir, ISD is in Andhra, but branch is in Tamil Nadu. Then SGST will be transferred as IGST credit. That is what the concept. Okay. Now, sir, this should be done on monthly basis, sir. Whatever is there in that month, that should be closed in that month only. Later on, you cannot proceed with that. And for this, you should file GSTR 7 within 13th of the next month, and that will get reflected in the opposite fellows 2B. And based on that, they will take ITC. Okay. And please understand, ISD is only to facilitate this credit distribution mechanism. So you cannot raise an RCM invoice on ISD, because ISD registration is purely for distributing the credit, not for tax payment. So if there is any RCM liability on ISD, that cannot accept it, that cannot accept that invoice, so they should take a separate registration and get the invoice in that name. So RCM supplies cannot be received in the name of ISD. That is important point, please remember. Okay. So now, obviously, sir, ISDs may be receiving invoices and they are distributing the credit. The same way, ISDs will be receiving credit notes or debit notes also. Accordingly, they will distribute the credit. If it is debit note we are getting, ITC will increase, so ISD will distribute more credit. No, sir, ISD is receiving credit note, then ITC should reduce. So ISD will reduce the credit distributed to the branches. That plus or minus will be keep on happening only. Okay. Suppose we have ISD has received a credit note. ISD has received a credit note. Then what ISD has to do? ISD, when they are transferring the credit to the branches in the next month, sir, how much ever we are transferring, from that we have to reduce that credit note amount and we should transfer. But sir, imagine this month I should transfer 2000 to them, a particular branch. Let us assume Tamil Nadu branch, we have to transfer 2000 rupees. But I have a credit note in which I should reduce 3000. 2000 I should send them, now distribute the credit. Now 3000 I should reduce. Suppose 2000 I should distribute, only 500 I should reduce now as per the credit note. 1500 I will distribute to them, 500 minus. But sir, I should distribute to them 2000 only, but as per credit note I should reverse to them 3000 rupees. 1000 shortfall is there? No. Then what will happen? Sir, you don't distribute anything to them and 1000 rupees add to your output tax liability. That is what the concept. So that is what the concept. Fine. Now here there is a small problem. Look at this. Pause the video. Just try to see the problem. See what they are trying to do is, sir, there is an input service distributor registration. And this is in Maharashtra. For the month of March, they give the following details. Sir, this is Ganganagar branch in Rajasthan, Madhugiri in Karnataka, Kosala branch in Uttar Pradesh, Mumbai branch in Maharashtra. You see, Mumbai branch is within the state. So any transfers are happening, CGST will go as CGST, SGST will go as SGST, IGST will go as IGST. You should understand that. Now, sir, turnovers they have given. Okay, turnovers we need. They give for last quarter only. We need it for the ratio how you split. Sir, ITC is specifically attributable to these branches. So these are the ITC which is specifically related to Ganganagar branch, related to Madhugiri and all these things not available, and these are related to Mumbai branch. Okay, so these are with ISD. This will be transferred to these people. This will be transferred to these people. You know, because this is outside Mumbai, outside Maharashtra. Everything will be transferred as IGST to that branch because it is specifically available to that branch. This will be transferred as it is, IGST as IGST, CGST as CGST, SGST as SGST, because it is related to that. If you see that there are ITC available on input services used commonly for all the branches, CGST 60,000, SGST 60,000, IGST 1,20,000. This they should split between all the branches, correct? In what ratio they will split? So here it is 50 lakhs. So 20%, 10%, 30%, 40%. So they will split in the ratio of 2 is to 1 is to 3 is to 4. Okay. In that ratio they will split. So you just pause the video, try to get the answer for this. How much the credit will be distributed after distributing the credit? How much will be the total balances of ITC in those respective branches? You just try to understand, pause the video, just go through this and try to understand the answer. Then I will just scroll and display the answer. But do it sincerely, please do it sincerely. Pause the video and try this, please. Yes. Now if you see, sir, this is the final answer. You can pause the video and take the screenshot, or you can pause the video and check the answer. Right. Hope it is clear for you. So with this we are done with input service distributor concept, and there is something related to a small issue and clarification here. Sir, whether head office can avail ITC in respect of common input services procured from a third party but attributable to both head office and branch offices, or exclusively to one or more branch offices. Sir, whether we can issue tax invoice under section 31 to said branch offices for the said input services, and branch offices can avail the same as ITC, or whether is it mandatory for the head office to follow the input service distributor mechanism for distribution of ITC in respect of such common input services. The head offices are receiving common input services which are belonging to both head office both head office and branch offices, are sometimes exclusively related to one or more branch office. In that case, sir, head office, here the clarification is, sir, head office can there is tax invoice on the branch office and distribute the credit, or separately they should take a ISD registration, was the doubt. Then it is clarified. See, they can distribute the ITC in respect of such common input services by following ISD mechanism. ISD mechanism can be opted only if the said input services are attributable to the said branch office or have actually been provided to the said branch office. In case of ISD mechanism is opted, head office is required to get itself registered mandately as an ISD. Or they can also issue a tax invoice under section 31 to the concerned branch offices in respect of the common input services procured from third party by head office but attributable to the said branch offices, and the branch offices can then avail ITC on the same subject to provisions of section 16 and 17. Similarly, head office can issue tax invoice under section 31 to the concerned branch offices only if the common input services have actually been provided to the concerned branch office. Simple, what they are trying to tell. So head offices, when you are receiving some services related to branch offices, either you follow ISD mechanism or you just raise the tax invoice under section 31 on the concerned branch offices and close that concept. That is what they are trying to tell. A small clarification, just go through that. So now we are seeing the last step of this chapter, rule 86A and 86B. Rule 86A, first of all, sir, commissioner or any authorized officer can restrict your ITC utilization, to be utilization actually. Why he can restrict your ITC utilization? Because if your ITC balance is being reflected of the because of the supplier filing the invoices, your supplier has filed the invoices and that invoices are reflected in your 2B, and that supplier is a person who is not even existing. That means you took those suppliers have to fake registration and sold something to you, or they are not doing business from the declared place of business, or without receiving goods or services you have received that invoices in your 2B. In such cases, or the tax has not been paid by the supplier to the government, or the registered person who is availing ITC, that means the recipient itself is found non-existing or not conducting the business from the registered place. So either supplier is not existing or not doing business from his registered place of business, or he has just issued invoice without supplying goods to you, or supplier has not paid tax to the government, or you, the recipient, has not been found existing or not doing business from the registered place of business. In such cases, the proper officer can restrict your ITC utilization, or even if you are not in possession of tax invoice or valid documents regarding that purchases, then also he can restrict your ITC utilization. That is rule 86A. Okay, so who has the authority? All the stuff that has been given, you can just take care of it. Now coming to rule 86B. Rule 86B is nothing but, actually in simple words, rule 86B says at least 1% of the liability, at least 1% of your gross GST liability to be paid in cash. That is what it says. Be paid in cash. That is what it says. Am I clear? 1% of the liability to be paid at least in cash is what rule 86B all about. So when this rule 86B is applicable, this rule 86B is applicable when your supplies in the month, please be very careful, supplies in the month exceeds 50 lakhs, but other than exempt supplies, other than zero rated supplies, sir, other than exempt supplies and zero rated supplies, sir, if it is exceeding greater than 50 lakhs, the taxable supplies in that month, then rule 86B is applicable. So when this rule 86B is applicable, what is your primary duty? Your primary duty is, sir, you should discharge at least your gross GST liability, at least 1% you should be discharging in cash only. That is what the point. Even though you have sufficient ITC balance, you cannot use full ITC balance. At least 1% you should pay in cash. Okay, so look at this example, sir. The total value of interstate supply of Kasi and Sons for the month of Feb is 100 lakhs, exceeding 50 lakhs. GST is 18% full IGST. So now IGST payable is 18 lakhs, but amount available in credit ledger is 20 lakhs. And sir, amount may be available in e-credit ledger 20 lakhs, but at least 1% of this liability you should discharge in cash. So 18 lakhs, what they should do, sir, 18,000 at least in cash, and 17 lakh 82,000 they can use ITC. Okay, so that is what the concept. But there are certain crazy things here, exception to that rule 86B. What are the exceptions, ma? Like rule 86B you need not follow. When rule 86B you need not follow? Sir, you need not follow rule 86B when, suppose if you are an individual, the sole proprietor, partnership from the partners, HUF the Karta, company the director, AOP BOI the members, trust, board of trustees, these people have paid their personal income tax liability more than 1 lakh in each of the 2 last financial years for which due date is over. That means based on these people, sir, based on these people, members of board or trustees, all that stuff, based on these people personal income tax liability in the last 2 financial years, these people has paid more than 1 lakh as their income tax liability, then for this particular company or partnership firm or even individual, for them rule 86B is not applicable. So this is one case where rule 86B is not applicable. Another case, sir, you have a track record, you are a registered person, you have a track record of claiming GST refund from the department, and in the last preceding financial year, if you have claimed GST refund more than 1 lakh, maybe because you are having unutilized credit ledger balance because of zero rated supplies or inverted duty structure, whatever it is, then also for you rule 86B is not applicable. Okay, so this is another case. Next, sir, if you see the cumulative liability till date, sir, I have already paid, discharged more than 1% in cash, sir, then you need not follow rule 86B. And finally, sir, if it is like government department or public sector undertaking, local authority or statutory body, for them also rule 86B is not applicable. So you have understood, don't trouble the trouble here. Okay, if you trouble the trouble troubles you. I am not the trouble, I am the government. Okay, so that is what the point all about. So there rule 86B is not applicable. Okay, so that is what the concept. With this we are done with rule 86A and 86B also. So we are going through the next clarification here regarding ITC on availability in respect of demo vehicles. See, generally, I am a car dealer. I am purchasing cars and selling cars. So when I am purchasing cars and selling cars, I have certain demo vehicles. So certain cars are kept as demo vehicle for like test drive, etc., etc., all that. Whether I can take ITC on that or not is the first question. See now, if I am an authorized dealer where I am selling cars, so the dealer is selling the cars. Dealer sells the cars. So he will provide trial runs, demonstrate the features of the vehicles, all that stuff. For that, he will purchase the vehicles and he will use certain vehicles as demo vehicles. So there, ITC is not blocked. That means here ITC available. ITC available. Now, no sir, I am not using the cars what I have purchased for giving demo or trial, etc., all the stuff to the customers, but I am using it for transportation of my staff, employees, management, etc., sir. Then ITC is not available, so ITC is blocked. Here ITC is blocked. Okay, this is second situation. The final situation, the interesting part here is, sir, what you are doing, you are not an authorized dealer who will sell the cars directly to the customer. You are just acting as an intermediary or an agent where the manufacturer of the cars directly will sell the cars to the customers, but you are acting as an agent to sell the cars and you will take some commission for that. What you are doing for providing your services as an agent, sir, for providing your services as a agent to provide marketing services, vehicle test drive services, all that stuff, where you are not directly involved in vehicle purchase and sale. In such cases, you are, as I told you, manufacturer will directly issue invoice directly to the customers. Okay. Now the point is, as an agent here, I am purchasing some demo vehicles, correct, for test drives, and after certain time period is over, I will sell them. Now I am buying the car for providing my services as an agent to promote the car, all the stuff. I am not engaged in further supply of said vehicles. Okay, who is selling the vehicles? Manufacturer is directly selling the vehicles to the customers. As I have already told you, invoice is directly raised by the manufacturer to the customer. In such cases, ITC is not available. Sorry. That means here, dealer is not actual seller of cars. Dealer is not actually the seller of cars, but he is an agent of manufacturer. Okay, so now, sir, whether this dealer is capitalizing the car, not capitalizing the car, all the stuff doesn't matter. He cannot take ITC because he is just providing service as an agent. He is not buying and selling the cars. Okay, so dealer is not buying the, better write down, dealer is not buying and selling the cars. So whether he's taking, capitalizing the point or not, all the stuff doesn't matter here. So ITC on demo vehicles does not depend on the capitalization. As you know, the exception in 17 subsection 5 is, if you are engaged in further supply of such conveyances only, you can take ITC. Here you are not engaged in further supply of such conveyances, you cannot take ITC. No sir, as we have discussed in the first case, sir, I am the dealer, I am the authorized dealer where I will sell the cars also to the customers directly. For that purpose, I am buying the cars and selling the cars, and for that purpose, I made certain vehicles as demo vehicles or test drive vehicles, all that. I can take ITC happily because I am buying the cars and selling the cars. So there is the clarification with respect to that. Next one, if you see, that is related to the clarification with respect to time limit for availing ITC in case of RCM supplies, where RCM supplies are there and the recipient is required to raise tax invoice. The doubt is, what is the time limit to take ITC? Time limit to take ITC is section 16 subsection 4. But sir, in 16 subsection 4, they talk about the relevant financial year in which the invoice is raised. From that, you should see 30th November of the succeeding financial year or actual date of filing, annual date of the relevant financial year, correct? Now, in this case, which financial year I should take? Then the law says, see, when the recipient is required to raise tax invoice, the relevant financial year will be the financial year in which that invoice has been issued by the recipient under section 31 subsection 3 clause F. Simple. Just like supplier has to raise invoice, recipient has to raise invoice. And when recipient has to raise tax invoice, so what financial year he is raising, from that only you have to, the recipient has to calculate the time limit for availing ITC. So he has an obligation to raise tax invoice under section 31 time limit that he has to follow, and accordingly ITC should be taken. But sir, if there is any delay in issuance of such invoice because of there is late payment of tax also, then automatically the interest and penalty will come into picture under section 122. Okay, so simple, recipient has to raise tax invoice and he has to pay GST under RCM. then he should raise the tax invoice within section 31 time limit, and the time limit to take ITC on that is nothing but in which financial year he has raised invoice, succeeding financial year 30th November or actual date of filing annual date of the relevant financial year, whichever is earlier. So that is the point. That means what we are saying, you should raise invoice within section 31 time limit and take ITC accordingly. If you are not raising the tax invoice according to the time limits in section 31, then because of that late payment of tax happens, and because of that you should pay interest on the tax as well as you are subjected to penalty, right? So that is what the concept, right? That is what this clarification all about. The next clarification is with respect to ITC on ducts and manholes used while constructing this optical fiber network. Uh, so in that case, in the construction of optical fiber cables or networks, so they are using ducts and manholes. On that, whether we can take ITC or not, in that department has clarified. Generally, plant and machinery, 17 subsection 5, you know, sir, plant and machinery is an exception, you can take ITC on that. So ducts and manholes will be considered as plant and machinery. They are not being specifically excluded from the definition of plant and machinery. That means ducts and manholes are plant and machinery. Ducts and manholes, ducts and manholes are plant and machinery. So you can happily take ITC. You can happily take ITC. That is the concept. Okay, right. So the next one is with respect to clarification in respect of entitlement of ITC by insurance companies on the expenses incurred for repair of motor vehicles in case of reimbursement mode of insurance claim settlement. Please understand, see, now, sir, I have a car and there is a small accident where I should change the silencer of the car or something, there should be some spare parts etc to be changed or whatever it is. Now the point is, sir, there are some repairs and maintenance involved here, and this amount is borne by the insurance company. Now here the point is whether insurance company can take ITC of it, is what the point. If you remember 17 subsection 5, there is an exception where normally general insurance repairs and maintenance servicing or locked credits, but if it is general insurance company, they can take ITC. So sir, general insurance companies can take ITC of the repairs and maintenance taken for the vehicles. Now here the point is, sir, how they will provide this insurance. Now please understand, there are two modes. One is cashless, the other is reimbursement. What does it mean, sir? Cashless means, understand what happens, the repair services are done at network garages of insurance company, and the insurance company pays approved charges to the garage. Invoice are issued by garage in the insurance company's name. Now see, for example, my vehicle got damaged, all this stuff, I will drop the vehicle and that vehicle to the insurance company. Insurance company will take that vehicle to the garages which are having like the insurance companies with whom that garages are having MOUs, all that. So within their network garages, so they will do the repairs. So now in that what will happen, sir, whatever the repairs are there, that let us assume 1 lakh repairs, 80,000 is approved, 80,000 is approved, and 20,000 excess cost. Now 20,000 I will pay to that garages, network garages. 80,000 directly insurance company will pay, full cashless processing, simple. That means insurance company will not take even 1 rupee from me. Okay, this is one way. The other way is the reimbursement. That means, sir, I will take the vehicle to a non-network garage with whom insurance company doesn't have any MOU, all that. Now I will pay the full amount whatever is there, and I will give the bill to the insurance company. Insurance company will do reimbursement to me. But here the interesting thing is, sir, the bill should be in the name of insurance company, then only insurance company can take ITC of that. Okay, so the garage issues the invoice in the insurance company's name without providing credit for repair cost. Okay, policy holders will pay it and take reimbursement from the insurance company. These are two methods here. So I hope you understood. One, there is repair and maintenance for my car. Sir, in both the cases, actually this point is for both. There should not be any line. So the same is applicable here also. We understand, sir, insurance companies, repairs and maintenance, whether they are doing cashless things or they are doing reimbursement to the customer, where customer will get the repairs and maintenance and claims reimbursement from the company. Both the cases, they are eligible for ITC under section 17 subsection 5. So blocked credit will not apply. There is an exception to blocked credit. So hope you are clear with this. Now the issue is actually, sir, as I told you, 1 lakh is the repair cost. 1 lakh is approved, 20,000 is excess. Correct? Sir, if at all, to what extent ITC is available to the insurer in case of two separate invoices by the garage for repair services, one to the insurance company for approved claim cost, another to the customer for any excess amount. So as I told you, 80,000 is to the garage and 20,000 excess amount to the customer. We have given the invoice. Now for the insurance company, ITC is available to insurance company only on the invoice issued to it. Subject, of course, the said amount is reimbursed to the customer. Please understand, that means insurance company can take ITC only on the 80,000 because that is the burden they are taking. Correct? They are not taking the burden of entire 1 lakh. So that is the point. Okay, sir. So the garage fellow gave 80,000 invoice to insurance company, 20,000 to the customer. Insurance company can take ITC only on the 80,000. Okay, fine. The next thing, what is the extent of ITC available to the insurance company in case single invoice is issued by the garage covering the full amount for repairs and services, and the insurance company reimburses only the approved claim cost? Full 1 lakh, that fellow giving the invoice, garage fellow, to insurance company in the name of insurance company. Can insurance company take 1 lakh ITC fully? No, only 80,000 again. So ITC is available to the insurance company only to the extent the reimbursement is approved, okay, to the insured, not on the full amount, not on the full invoice value. This is another thing. So finally, what, whether ITC is available to the insurer if invoice for vehicle repair is not in insurance company's name? Obviously ITC is not available. You know, section 16 subsection 2 says, the invoice should be, you will be having a documentary evidence of invoice, and if that invoice is not in the name of insurance company, how will it get reflected in GST or 2B of insurance company? So it cannot take ITC. The insurance company cannot take ITC if the invoice is not in their name. Clear? So that is what the story here. Hope it is clear. A very good clarification again. So please make sure you are thorough with this. Mark it important. Okay, with this we are done with another clarification as well. So the next one, if you see, sir, if you remember, when we are going with valuation rules and when we are calculating the value of supply for the insurance premium paid for life insurances, all that stuff, sir, in the value of supply, we will exclude some portion when you are going through value of supply, all that stuff, sir. Even though the premium is paid 1 lakh rupees, from that, let us assume some 20,000, 30,000, 40,000, something or the other, based on valuation rules, we will remove some portion. Now the doubt is, should we reverse ITC because of this under rule 42 or 43? Was the doubt. Now there is a clarification regarding this. See, the clarification is on the requirement of reversal of ITC in respect of portion of the premium for life insurance policies which is not included in the taxable value. Understand, the premium paid in case of insurance policy, some portion of premium is not included in the taxable value. That is because of the valuation rules. This is neither a nil rated nor wholly exempt supply, and this is not a non-taxable supply. So you will not get a situation where rule 42, 43 comes into picture and you need to reverse ITC, all that stuff will not arise. That is what the concept they are trying to tell. A very simple and small clarification. Simple. What is that? Sir, any insurance premium, whatever you are paying on life insurance, the value of supply, some portion of the amount we will deduct because of valuation rules. For that purpose, you need not reverse any ITC under rule 42 or 43. That is what the clarification. So guys, hope you have enjoyed this lecture on input tax credit, a very important chapter, and we have revised it in a very effective way according to me. So hope you have enjoyed this lecture. So wishing you all the very best for your preparation and enjoy your reading. That is very important. See you all in another video. This is your Mr. GST signing off. Jai Hind.